Welcome to those of you who've just joined us in the session. Great to have you here. So I see lots of attendees still joining us, and I know we have several hundred more registered today, so I'm sure we'll have lots more continuing to join, but lots of content for us to cover today. So I think in the interests of time, we'll get started and kick off the session. So as you're doing already, feel free to introduce yourselves in the chat as we're getting started. If you'd like to say hello and let everyone know what organization or location you're joining us from. But brilliant to have you all here. And as I said, welcome to this half day of training on applying the IFRS Sustainability Disclosure Standards. So I'm Fiona Quinlan-Wells from the UNSSE team. Great to be here with you all today. And I've got several colleagues here with me that I'll be introducing you to shortly. But firstly, I'd like to really say it's fantastic to have you here in this training program. It's a truly collaborative effort, really driven by that demand we're seeing for more implementation support on the ISSB standards. And so I'd firstly just like to start by saying a thank you to the IFRS Foundation, the IFC, and other organisations who've supported this program and made it possible. And of course, a big thank you in particular to the Nigerian Exchange and in particular the NGX Academy team for hosting us today and bringing everyone together for this training. And of course, a big thank you to all of you as participants for joining us in the session today as well. So to get us started, I'm very pleased to say we're joined by Mr. Tony Ibeziako, who is Head of Primary Markets at NGX. And Tony's just going to be starting us off with a brief address to give you all a welcome to the session. So many thanks, Tony, for joining us, and I'll hand over to you now.
Thanks, Fiona. Good morning, distinguished participants, colleagues, guests, and esteemed facilitators from the IFRS Foundation and the UN Sustainability Stock Exchange Initiative. On behalf of the Nigerian Exchange Limited, NGX, it is my pleasure to welcome you to this important workshop hosted by our ex-academy focused on IFRS Sustainable Disclosure Standards, a timely and transformative topic for capital markets and corporate governance. In June of 2023, the IFRS Foundation launched IFRS S1 and S2, setting new global benchmark for sustainability-related financial disclosures. These standards are designed to drive transparency, strengthen accountability, and create long-term value across global markets. Here in Nigeria, the Financial Reporting Council has taken decisive steps, releasing a national adoption roadmap earlier this year. This phased approach paves the way for entities to begin reporting with mandatory adoption for public interest entities. This is more than a policy, it is a call for concrete action. Sustainability disclosures are rapidly becoming both a regulatory obligation and a strategic necessity. As Africa's leading securities exchange, the NGX is fully committed to fostering sustainable finance and responsible investing. Today's training is designed to help companies develop the internal capabilities needed to meet these new standards with confidence. We also recognize that sustainability is no longer an itch word or a buzzword. It is now central to business strategies, investment decisions making, and market resilience. By participating today, you are taking a proactive step towards compliance, competitiveness, and credibility in a rapidly evolving market. We extend our sincere appreciation to our partners, the IFRS Foundation, the US Sustainability Initiative Group, IFC, and SECO for their collaboration and support. Special thanks to our NGX Academy team that is led by Ugochi and Jide for orchestrating today's program and ensuring a seamless virtual experience. Thank you for joining us. We encourage you to engage fully, ask questions, and make the most of today's expert-led sessions. Together, we can shape a more transparent, accountable, and sustainable capital market. Thank you, Fiona, and I hope all the participants and the facilitators have a good day. Thank you very much.
Thank you so much, Tony. I think that sets us off with fantastic context. And as you say, I think it's brilliant to see the real leading role that Nigerian NGX is playing in taking forward these standards. So I'm sure that's what brings many of our attendees here today. And we're looking forward to getting into the content together. Brilliant. So with that, I'll just give us a bit of an overview on some of the practicalities of the session today before we start to dive into the content itself. So firstly, a few housekeeping points. You've probably noticed by now that as participants, you're muted in the training session. But as Tony said, we really do encourage you to engage and participate through the options that you have within Zoom. So as you're doing already, it's great to make use of the chat box to share any general comments and introductions as we move along. If you've got specific questions for the team, we encourage you to make use of the Q&A box for these questions. As Landon's just shared in the chat, that just allows us to make sure we can track and answer your questions. We do have lots of colleagues here today to support you in answering those questions. So we definitely encourage you to make use of that opportunity to ask your questions through the Q&A function. And then in terms of our format for the training, so as you're probably aware, we have 3.5 hours of live training together, and we do have an optional follow-on homework exercise that you can take away to continue your learning if you'd like to do so. As I've mentioned already, we'll have the live opportunity for Q&A throughout the session, so make sure to get good use out of that. And we really do encourage and ask for your participation in the session. So we're going to be using a number of interactive tools, including Menti and polls. So really encourage you to take part in those. And finally, if you take part in live training today and complete the course with us, you'll be able to receive a CPD certified completion certificate as well. So we'll tell you at the end of the training about how to get your certificate, but to do so, you'll need to fill out the survey that we'll share with you at the end of the training. So just to say a little bit about who's going to be delivering the training with you today. So firstly, I've introduced myself already, but I'm Fiona from the SSE Academy team, and I'm joined by my colleague Lois Guthrie, who's our senior specialist. Then from the IFRS Foundation, our speaker today will be Vanessa Hay, who is a capacity building fellow in the IFRS Sustainability Capacity Building team. I'm also pleased to be joined by her colleague Neil Stewart, who you'll probably see popping up in the Q&A box, who's supporting us with questions as well. So many thanks to Neil for that. And then in terms of the content that we're aiming to cover with you today, we have kind of 3 key learning objectives that we want to work through. So firstly, we hope to help you to understand the ISSB standards. So fundamentally, what are they? We're then hoping to move on to understanding how you can use the ISSB standards and really put them into practice in your organizations. And to support that, we're going to be taking you through the steps to develop a disclosure plan for your organization with a focus on applying the ISSB standards. So to help us achieve those 3 objectives, we've broken the training course down into a number of modules, which you'll see in that circle diagram on the screen there. So we'll be starting with Prepare up in the top left there, which is all around building on any existing knowledge you might have of sustainability reporting, thinking about its purpose, the overall reporting landscape, and how the global baseline of the ISSB standards has developed. That will then take us into our second module, Align, which is all around setting the direction for your reporting, thinking about how to apply and use the standards, and any additional disclosure requirements you might need to meet. We'll then move into Implement, which is all around your practices and systems. So thinking about how you can identify, evaluate, and integrate sustainability risks into your organizations. And then we'll finish off with Communicate. So thinking all around the final format for your disclosures. So where should you put them? How should you report efficiently and with confidence? And so just to show that another way in terms of how this breaks down into the training agenda, we'll sort of split the modules up across the time. And we do know 3.5 hours live online together is quite a long time. So we'll take a short break in the middle just to give everyone opportunity to refresh themselves as well. Alrighty, so just to share as well, Landon has mentioned this already in the chat, but all of the training materials we're going to be using today, so that's the slide presentation and the follow-on homework exercise, if you'd like to take part in it, can be downloaded from the SSE event webpage for today's session. So we'll share that link with you a number of times in the chat, but if you go to the resources section on the page that Landon has shared there, you can download this slide presentation. And there'll also be a number of extra hidden slides in that material just to give you a bit of supplementary detail, as well as hyperlinks to lots of the resources that we're discussing with you today. And as I've mentioned, another aspect that you can choose to take forward is the homework assignment, which is available from that page as well. So we'll talk through the structure of that as we work through today's training. There's no mandatory need to complete this, and you don't need to submit it to us, but it's just something that we've designed to help you to build out that disclosure plan that we're going to talk about today, and for you to take forward these conversations with your colleagues. And alongside that, just a few key resources to mention from the SSE. So I'll leave these for you to find on our webpage if you'd like to do so. But a number of resources that we've developed, including our model guidance on sustainability disclosures, which is aligned to the ISSB requirements and can support you. So Landon's just shared the link for you to access these resources there. Okay, but just to get us started, and as I've mentioned, we're going to be using Menti a number of times in today's session. So we just wanted to do a quick warm-up exercise in Menti to make sure you can access it and to get a sense from you all about what you're here for today and how much you already know. So Landon is just going to share the link with you in a second to access the Menti. I see that's just come through, and I'm going to also share my screen now to Menti, so you'll be able to see another couple of options for how you can join us in Menti. So probably the simplest thing to do is to follow that link that Landon has just shared. But if it's easier, you can also use that QR code at the bottom of the screen there. And you can also go to menti.com and enter that 8-digit code that you can see at the top of the screen. But our first question, just to get us started, is just to share with us a few words about why you've joined today's training and what you're hoping to get out of the session. So give you all a second to have a quick think about that. Okay, so I'm seeing curiosity, knowledge, experience, sustainability. Great. Learning, information, global practices, growth, compliance, disclosure, information. See sustainability, knowledge coming up as the big words. I see someone's shared as well in the chat, Loretta, clarity, compliance, and impact. I think that's a nice combination. Fantastic, everyone. I think, yeah, hopefully lots of things that are well aligned to what we're aiming to cover with you all today. So yeah, hopefully we can support you in those objectives. Fab. So I've got one second warm-up question for you all, which I'll just move on to now, which is just to get a sense from everyone as to how comfortable you are at the moment with those different tasks or learning areas that we're aiming to develop in today's session. So you can use that sliding scale there to indicate from the left-hand side, maybe being not comfortable or not familiar, to the right-hand side, maybe knowing a lot and being quite familiar with the topics already, to let us know where your existing understanding is. So how well could you explain what the ISSB is to your colleagues? How could you use the ISSB standards? And to how well do you know about developing a sustainability reporting strategy? Give everyone a second just to let us know what they think about that. Okay. So those who've responded so far, I think there's a bit of a range. You can see that in the bar that sits behind, but the average score, I guess, is coming out sort of on the lower end of comfort and understanding at the moment, which of course is very understandable and why you would have joined today's training. So No worries at all, but we'll revisit that later in the session and hopefully be able to see that we've moved things along. But good to get a bit of an existing sense of where you're all at today. Great, thanks everyone for sharing. So we're going to be using Menti a few times throughout the session. So I recommend to keep that link open in the background and we'll return to it again later. But for now, I'll get us started with the first section of the training content before I hand over to some of my other colleagues as well to share more. So before I do, I just have a quick disclaimer that I need to share with you. So I'll just leave this here for a moment. And really the purpose of this disclaimer is just to explain how we're going to be using examples in the training today. So we'll use a number of company examples of disclosure, and these are really simply here to add some color to what we're talking about. But the examples shouldn't necessarily be seen as the best or the right way to approach this. Of course, we know that each company's circumstances are unique and you need to approach this in the way that works best for you. But we hope these can offer a little bit of inspiration to help get you started. Okay, with that established, I'm going to be getting us started in the first section of Module 1, which is all around building that solid foundation of knowledge. So thinking about what you might already know on this about the standards that exist in sustainability reporting that have informed the development of the ISSB. And in this module, we cover sort of three key areas. So we think about the purpose of reporting. So what's the real case for sustainability reporting, including the market and business drivers that might be leading to more adoption. We'll then talk a little bit about the reporting landscape and how it's becoming simplified. And then we'll finish by introducing the global baseline. So talking about the core concepts and requirements that sit within the IFRS S1 and S2 standards. Okay, so to get us started on the purpose side of things, we've got a quick poll question for you firstly, just to get a sense of your drivers for disclosing sustainability related information, or maybe if you're not reporting yet, what your drivers are just for joining us in today's session. So we know that there's many different reasons organizations are progressing their disclosure, but take a moment and let us know which of these is kind of key for you, and you can select more than one option there as well if you have multiple different drivers. I'll give you a second and then we'll have a look at that and explore some of the trends behind this. Great. I see lots of people taking part in the polls, which is always helpful. We'd like to have that as much as possible. We do like to keep them fairly rapid fire, though, in the interests of time. So I will close that poll there and share the results. So if you didn't get a chance to participate this time, don't worry, we'll have lots of polls throughout the session. But I'm seeing at the moment regulatory requirements and investor interest coming out as your top sort of two drivers for reporting, and also sharing your own management's objectives maybe as a close third. So yeah, I think that's quite a common picture that we're seeing at the moment. And of course, with what we heard from Tony at the start regarding the roadmap that the FRC has developed in Nigeria, very understandable that that regulatory driver will be bringing many of you to this topic today as well. Great, thanks for sharing that. So one of the key things, I guess, that was highlighted there was the investor angle as well. And I suppose we just wanted to say a little bit about that. So in this visual, we're seeing the data on the number of signatories to the Principles for Responsible Investment, which you can see has really grown if we look back to maybe 5 years ago from now, in terms of the number of investors that are really supporting those principles. So we just wanted to dig into a little bit about why is it that investors are really interested in this sort of information now. So what I think we want to highlight really as a key point here is that the driver behind this demand from investors is relevance of the financial effects of sustainability issues. So the data we're seeing here is from a study of retail investors, which was carried out by Morgan Stanley. And what they found was that the top driver, at least of these individual investors, that was driving their focus on sustainability was actually the financial performance relating to this topic. So you can also take a closer look at this study in the link that's at the bottom of the screen if you take a look at the handout there. But before we move on, we'll just take a little bit of a closer look at what we mean by financial performance. So something that's important to keep in mind for today's training is that we're going to be talking about disclosing financially material sustainability related information. So we're going into more depth later about what we mean by material, but we want to be clear from the start about the sorts of financial effects that investors are going to be looking for more information on. So starting with the effects on a company's performance, this is what we often see reflected in the statement of profit or loss, which will show your income or revenue and expenditure. So sustainability risks and opportunities can have a financial effect by changing the revenue mix or total revenue of a company. For example, if there's a change in demand for its products and services. And we can also see changes in expenditure. For example, if there are increased operating costs due to rising energy prices or greater need for R&D expenditure. And then the second kind of key aspect to clarify here is to talk about effects on a company's financial position. So this is what we often see reflected in the balance sheet or the statement of financial position. And for example, here, there could be changes that a company could see as a result of sustainability and climate issues due to changes in assets or liabilities. For example, portfolio values could change if the assets are repriced to reflect sustainability risks. And secondly, we could also see changes to financing and the costs of capital. For example, increases in insurance premiums as a result of climate risks. And so I just mentioned risk a few times there, and then there's a few key concepts relating to risk that we just want to establish early on. You've probably seen this visual before from the World Economic Forum's global risk report showing the sort of top 10 global risks in the near term and the long term. And what we want to highlight here is that what we're often thinking about with sustainability issues is those risks that may not pose a significant threat today, but that actually might be the most material risks 10 years from now. And so when we're preparing our disclosures, it's important that we're thinking about the resilience measures that we implement or might need to invest in today to mitigate potential future negative impacts and also to increase opportunities in the future as well. And what that could mean is that the financial effects we were just talking about could occur much sooner than the risk itself if, for example, we have to take mitigation action that requires investment. And then a second key thing just to highlight relating to risks and opportunities is their interconnectivity. And here we see another visual from that World Economic Forum report, and really just showing here that all those different types of risk that we talk about within sustainability are very much interconnected. So whilst in the training today, we're going to be talking about the two IFRS standards S1 and S2, S1 for general sustainability topics and S2 for climate. Of course, when we're thinking about how we report this information, we need to do our best to reflect that interconnectivity between the topics and think about this in a holistic way if we can. Okay, so that's just a few key concepts we wanted to establish early on. We're now going to be moving in to talk a bit more about the landscape for reporting, which I'll be handing over to Lois for.
Thank you, Fiona, and hello, everybody. So we've heard from Fiona about why sustainability disclosure is important to investors and others. And now we're going to look at how IFRS sustainability disclosure standards were developed within the background of the landscape of existing reporting standards. But before we do that, we would like to hear from you about what reporting frameworks you are currently using. So you'll see the Zoom poll has come up asking you which frameworks do you currently use, and you can select all that apply. So are you responding to CDP? Are you using the standards of the Global Reporting Initiative, the Integrated Reporting Framework, the Sustainability Accounting Standards Board standards, the recommendations of the Task Force on Climate-Related Financial Disclosure, the UN Global Compact Principles, or something else? And if it is something else, please tell us in the chat. I'll give you a moment to think about that. And I'll just let Fiona and Landon know that I can't quite see how the results are progressing. Now I can. Thank you. Thank you. Okay, let's close the poll there and share the results then. And yes, quite a wide variety of approaches here. The majority of you using GRI, closely followed by CDP, the Integrated Reporting Framework, and the UN Global Compact Principles. So you can see there's quite a spread of different practices within this group at the moment. Thank you for sharing that. Let's have a look then at how the organization that has developed the standards we're looking at today, and that's the IFRS Foundation. It's a not-for-profit public interest organization established to develop high-quality, understandable, enforceable, and globally accepted accounting and sustainability disclosure standards. So you can see at the bottom there are two independent standard-setting boards within the foundation. The International Accounting Standards Board in the dark blue, formed in 2001, and their standards are in place in over 140 jurisdictions around the world to help companies prepare and report their financial statements. And the International Sustainability Standards Board in the light blue, formed in 2021. And as Tony told us earlier, they released their first two standards in 2023, following strong market demand for those standards and the establishment of the ISSB. Now, governance of these two boards is provided by IFRS Foundation trustees, and they are in turn accountable to a monitoring board of public authorities. Because the IASB and ISSB are within the same foundation, they work closely together to ensure that their standards complement each other. So how did all this come to be? Well, on this slide, you will see the logos of different organizations that have contributed to the evolution of sustainability reporting. They have much in common, actually, in terms of their objectives, but there are some differences, or there were, in the guidelines and standards that they offered. But although this looks like a lot of logos and perhaps could look confusing, the main message I want you to take from this slide is it's actually a picture of simplification and harmonization, and that is indicated by the arrows that you see on the screen. So at the bottom, you'll see there are three organizations whose work was consolidated into the IFRS Foundation's work, and they are the Climate Disclosure Standards Board, Integrated Reporting, and SASB. So if you were using any of those standards, that work is now consolidated into the ISSB standards. Similarly, with the TCFD, the Task Force on Climate-Related Financial Disclosure, their recommendations have also been absorbed into the ISSB. The structure of the TCFD recommendations and much of the content were used as the basis for forming the ISSB standards. CDP has aligned its climate questionnaire with ISSB standard S2 on climate, and the work of the Transition Plan Task Force, to the extent that it deals with disclosure, has also been absorbed into the IFRS Foundation. Now, all of those organizations we've talked about, they focused on information to serve investor information needs. GRI, of course, they collect information for a wider stakeholder group, but there's a memorandum of understanding and other agreements between the IFRS Foundation and GRI, and they're committed to jointly identifying and aligning common disclosures. So really, this is a picture of harmonization and simplification. Now, I just mentioned that the TCFD's work has been absorbed into the ISSB's standards, and that the ISSB also has taken over monitoring of climate disclosure. So what do you think is the answer to this question? Companies that disclose using the TCFD recommendations automatically comply with the ISSB standards. Is this true or is this false? Give you a minute to think about that. There's quite a pattern emerging here. So in the interests of time, I'm going to end the poll and share the results. So you can see that most of you said that this is true. Some of you said it's false. Now, I can understand completely why you said it's true, because we've just explained that TCFD's work has been absorbed into the ISSB standards, but actually it's false. Now, those of you that use TCFD, the TCFD recommendations are very, very similar to what's in IFRS S2 climate disclosure. So you will be a long way towards having the information you need for climate disclosure under IFRS S2. But the reason the answer to this is false is because there are some differences between the TCFD recommendations and ISSB S2. So let me take you through some of those. The differences are summarized in this little comparison document that you can see a thumbnail of on the left-hand side. So if you want more details, please do look there. As we said, TCFD has finished its work now, and the IFRS has responsibility for their work. But really, the reason the answer to the question was false is because in some cases, S2 uses different wording from the TCFD recommendations, but this has the same meaning. Secondly, S2 sometimes requires more detailed information. So this might be information, for example, about whether and how carbon credits are used to satisfy targets. And thirdly, S2 sometimes asks for additional requirements and has additional guidance when we compare it to TCFD. So those additional requirements might be on sector-specific disclosures, which we'll come on to look at later. So let's talk a little bit about the ISSB's main objective. Now, the objective is to develop standards that are treated as a global baseline. That is, they provide a common language for sustainability disclosure. They enable comparable and consistent sustainability disclosure across global capital markets. Now, the ISSB, as we heard from Tony earlier when he mentioned the adoption strategy, is working with jurisdictions around the world to support that global baseline. But just because we have a global baseline doesn't mean that jurisdictions can't add some specific requirements necessary for understanding sustainability in their jurisdiction. And they can also add requirements that are designed to satisfy broader multi-stakeholder needs. So in summary, what this means is that the global baseline can be built upon with building blocks that serve jurisdiction-specific information needs and broader multi-stakeholder information needs. So taking this building block approach reduces the need to duplicate information because there's a globally consistent baseline of disclosures, but still allows more information to be reported where it's jurisdiction specific or is suitable for multi-stakeholder needs. Now, just to add briefly, there's been support for this global standard that's represented by the ISSB's standards S1 and S2. IOSCO, which is the International Organization of Securities Commissions, has endorsed the ISSB standards and asked its members about how they can incorporate ISSB standards into their regulatory frameworks. We see new audit standards from the International Auditing and Assurance Standards Board to support sustainability disclosure. We have the IFRS Foundation's Regulatory Implementation Programme that helps jurisdictions around the world with planning and preparing for voluntary and mandatory adoption of the standards. And of course, there's activity like this session today to help market participants to voluntarily adopt the standards as well as through mandatory channels. So I'm going to hand over to our colleague Vanessa now, who's going to start introducing us to the ISSB standards.
Thank you. So earlier we have like Fiona and Lewis sharing about the business case and market case for the sustainability reporting and the evolution of the landscape and how it is being simplified. So let's introduce IFRS S1 and S2. So as we start, it's important to know that there were some key terms that should be aware of, and you can find the definitions in your handouts as well, but I wanted to briefly mention them here. So first of all, we'll be saying the phrase sustainability-related financial information quite a lot. This can refer to a broad set of sustainability issues, including climate, nature, or biodiversity, human, social, or others. And second, the second phrase we will mention more oftenly is sustainability-related financial information. It is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. And the third phrase is sustainability-related risks and opportunities. So they are those could reasonably be expected to affect the company's cash flow, the access to finance or cost of capital, such as it could affect the company's prospectus. And the last phrase we would also talk about is the general purpose financial reports. It includes a company's financial statements and management commentary. You might know this as a management report, management review, or strategic report. So some regulatories require specific disclosures in certain parts of general purpose financial reports. So we use this generic phrase throughout the contents. So moving on, anyone familiar with TCFD will recognize the same 4 core pillars or the 4 content areas for the ISSB standards. So those are governance, strategy, risk management, and metrics and targets. And for each core content area, there are a set of key disclosures to be addressed, and the standards provide every detailed guidance on these requirements. And we will discuss each of the 4 content areas today, but I strongly encourage you to download our standards as part of your homework assignment to get familiar for those 4 contents. And next, to all the preparers listening, let me start by saying don't be afraid. Yes, there's a lot of information to understand, but you might be surprised that some of the detail is similar. And for all the accountants listening, you too will be relieved to see so many of the conceptual foundations developed by the IASB in the ISSB standards. So let's start with IFRS S1, or to give it like a full title, general requirements for disclosure of sustainability-related financial information. So IFRS S1 sets out general requirements for the contents and the presentation of sustainability-related risk and opportunities. If you are familiar with TCFD, I've seen in the last Zoom post, so many of you choose TCFD, you will see the same architecture or skeleton apply throughout the standards. So our IFRS S1 asks preparers to refer to and consider the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities and identify material information. So the SASB standards are organized by the industry, so it can enable a company to identify disclosure topics or metrics applicable to its business model and operations. And finally, the standards can be used in conjunction with any accounting requirements. So let me move on to the S2. So the scope of S1 is for all sustainability topics except for climate. And the climate will be covered by the S2. So the second standard, IFRS S2, focus on climate disclosures. And we're building on the same foundation of S1. For example, firstly, it fully incorporates the recommendations of TCFD. And secondly, it sets out the requirements for a company to disclose material information about its climate-related risk and opportunities. And lastly, it requires the disclosure of both cross-industry or industry-specific information. So moving on, In terms of the climate-related risks, this include both physical and transition risk, and which we will come back to them later. And the other specific, like climate-related disclosures, are required. For example, need to disclose a scenario analysis and the GHG emissions, such as scope 1, 2, and 3. And moving on, the preparers must also refer to and consider the applicability of this industry-based guidance on implementing IFRS S2. As we have said already, this is organized by the industry, enabling a company to identify company-related disclosure topics and metrics applicable to its business model and operations. So furthermore, S1 and S2 are actually not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risk and opportunities, the company must apply both IFRS S1 and IFRS S2. The reason behind is that because IFRS S1 sets out general requirements for the type of information that needs to be provided in order to be decision useful for the investors. And IFRS S1 also explains the concept of materiality and how companies identify material sustainability related financial information. And next, let's consider some of the conceptual foundations that underpin the ISSB standards, which might be new to anyone like without an accounting background. So those concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. So to start with, the companies must fairly present a complete set of sustainability-related risks and opportunities, and also fair presentation also requires disclosure to be faithfully represented. To achieve this, the companies shall provide a complete, neutral, and accurate description of sustainability-related risk and opportunities. And furthermore, the reporting entity concept requires the organizational boundary for both sustainability-related financial disclosures and financial statements to be the same. In a simple word, the reporting entity in your financial statement or in your sustainable report should be the same. And another important concept is unconnected information. And we saw earlier when Fiona explained how different risks are often interconnected. The ISSB standards require companies to clearly identify clear connections, such as those between risks and opportunities, and the connections between the four pillars, and the connections between sustainability-related financial disclosures and the main financial statements. And next, let me hand over to Lewis. For highlighting an example.
Thank you, Vanessa. So this example that we're about to look at is to illustrate how companies make disclosures about different things that are connected. Now, because it is the first example today, just want to remind you of the disclaimer that Fiona gave right at the beginning, that these examples are designed to illuminate and inspire you. We're not presenting them as representing best or good practice. So this example is from a company called BHP. It's from their 2024 annual report and the section about how they manage climate risks and plan to transition to a net zero economy. BHP is a global mining company. So what do we see about connections in this extract? Well, there's three things to note. First of all, the company has conducted climate-related risk assessment and also done some scenario analysis about the potential effects of climate on its business. Now, what they've done is they've connected that and integrated their thoughts about the risk assessment and scenario into their strategy, but also as treated it as a sensitivity in their capital allocation process. So they're not thinking of climate separately here. They're making sure that the implications are integrated into their business strategy thinking and also treated as a sensitivity in their capital allocation process. Secondly, we see the company say that some of their assessments, particularly on physical climate risk, are still in progress, but they tell us that they propose to use the results to inform updates to their risk profile, including new risk management activities. So they plan to use those results when looking at the company's risk profile, corporate planning, and so on. Thirdly, at the bottom of the screen in the pale grey text, you can see that the company is connecting us to further information about how climate affects their business, so that we can see further information on how they use climate change when looking at their risk profile, corporate planning, their controls and adaptation methods, their operational activities, GHG emissions in the value chain. So they're showing us in this short extract how many things are connected. So back to you, Vanessa.
Okay, thank you. So before introducing like one last concept, so let's like take a pause here to test like one of those core concepts we mentioned earlier. So this poll is testing the core concept of connectivity, and also like Lewis has also shared the example of the connectivity. So let's take a short poll here. I've seen people are choosing now for the time benefit. Yeah. So for the time benefit, I think I will stop here. So actually, as we mentioned earlier, so connectivity, as we mentioned, so all of the options are correct. So it will need to actually consider like governance, strategy, risk management, and metrics, targets and margins targets, and also the second option, stability disclosures and financial statements, and sustainability risk and opportunities into our connected information. So all of them we should be considered in our connected information. And moving on, finally, one last concept I would like to mention, like share to you all about, is materiality. So materiality, as defined by the IFRS Foundation, is the information that, if omitted, misstated, or skewed, could reasonably be expected to affect the investor decision making. And we will come back to them later, but I just want to bring up the concept and the definition to you now. And moving on, during the ISSB consultation on the exposure draft, one of the key feedback topics was the importance of supporting preparers. So particularly those with more limited resources and those in emerging markets. So in addition to the standards and application guidance published in 2023, a number of educational materials or educational resources were also published and since published in our IFRS website. And since the others have followed, including the IFRS Knowledge Hub, and we are also in the process of gathering examples and case studies provided by our capacity building partners. And the SASB standards were aligned with IFRS S2 to help preparers seeking industry-based guidance, and the FSA credential was also updated with more plan to come. And I should also note that the IFRS Foundation's capacity building program launched at the COP27 is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. So let's take another pause, and we will take another Zoom poll before we ending the model 1. I can see one comment that we can leave more time in the Zoom poll. Yes, then we will give it more time here. So this Zoom poll tested like what water is like a vital input in your business, but ISSB standards do not currently have a specific standard on water. And what do you do? So let us like take more time here to get more participations to answer these questions. So the first option is do not disclose anything about water, and the second option is consult with sources of guidance listed by the ISSB, and third option, engage in consultancy to help, and D, copy your competitors' reporting. Okay, let me start ending the Zoom poll here. Surprisingly, I don't see any like people choosing D, but like normally in a previous session, like some people would choose D. Actually, the correct answer is B. Consult the sources of guidance listed by the ISSB. As we mentioned, like previously, we have a list of guidance such as our standards and our application guidance, and also SASB standards, and actually engage in consultancy to help the option C is useful, but it's not our correct answer. Okay, let me hand over back to Fiona for ending the module 1.
Great, thanks so much, Vanessa. And as you say, that brings us up to the end of our first module. So I'll just be doing a little bit of a summary now to wrap up on what we've covered so far. So firstly, we reviewed the purpose of sustainability-related disclosures. And a key takeaway we're hoping that you'll leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related information. So ultimately, if you're not aiming to make good use of that data that you're collecting to improve your strategic decision-making, you're really missing an opportunity and wasting some time. So make sure to do that. And if you do have operations in difficult to abate or high impact sectors, it's likely that your competitors may already be starting to disclose these risks and identifying the opportunities they're pursuing. And in the long run, that's going to start to leave your investors wondering why you're not addressing these topics. So it's certainly worth trying to get ahead of that interest, I think. And next, we looked at the evolution of disclosure standards and the formation of the ISSB with that aim to simplify the reporting landscape. Though I know a number of you noted that's still a work in progress, but I think, we're taking steps in the right direction, that's for sure. So when you're thinking about other voluntary disclosures aligned to other frameworks, you shouldn't see those as competing with the ISSB standards, but rather building on top of that baseline that the ISSB has aimed to provide. And then finally, we introduce the standards themselves and the important concepts that you need to understand in order to use them correctly, as Vanessa just took us through then. And I think a key point that I want to reiterate here is that these standards and the guidance that come with them are designed to meet the needs of investors. And then they are, as a result of that, heavily focused on those prospects relating to financial position and financial performance, as we talked about at the beginning of the unit. Okay, so to wrap things up, we have a quick exercise just to get us all thinking and reflecting a little bit on what we've covered so far. And in our first exercise, we're just going to be reflecting on what are the objectives of your sustainability disclosure. And this we think is something that will be important to set out in that disclosure plan that you develop. And so really the aim here is to be clear on what you're trying to achieve with sustainability reporting. And maybe this is relating to meeting mandatory requirements. Maybe it's responding to the needs of a particular stakeholder like your investors. And maybe it's just about being clear on what your organization can also get out of this in terms of benefits. So we recommend having a discussion about this with your colleagues and aiming to document your overall objective with your sustainability reporting. And this might also be thinking about where you are now versus where you want to get to. So perhaps you're starting at the beginning. So your objective might be just to get the basics in place. But perhaps if you already have some reporting, your objective could be about increasing your maturity, for example. So our next Menti slide, which you can access already, and I can see some of you have been responding to, is just to have an initial reflection really on what your front of mind objective is for your reporting, and just have a go at articulating that. So I have shared the link in the chat already, and I can see you're responding. So we'll just take a little look now together at your responses to that question and see what we've had come through. If you haven't had the chance to answer yet, feel free to keep answering whilst we look at those responses we've already had. So I'm seeing several answers here that mention transparency and showing your journey. Yeah, exactly. I think that's a real key thing here is, we don't have to have all the answers. We don't need to have implemented everything to be able to start to report and be transparent with our stakeholders about this. I'm seeing around accountability as well, exactly, and providing credible and verifiable information on environmental and social performance. Yeah, I mean, I think that's a key part of building that trust, isn't it, with your stakeholders? Someone's also mentioning around tracking progress and being accountable. Yeah, exactly. Trust mentioned again. And maybe demonstrating that innovation in your particular field in education tech, I guess, can go hand in hand. Yeah, exactly. Someone's also mentioning about improving their internal processes. Indeed. So not just thinking about what we put out there, but actually what that can tell us that we can use internally to bring in and improve the way we operate. And as you say, hopefully reduce emissions and risk at the same time. And then someone's mentioned about being able to objectively identify material risks and opportunities and then use those to inform strategic decision making. Yes, exactly. Like that's at the core of this, of course, is trying to connect between these risks and opportunities we identify and fundamentally how we can make our businesses more resilient for the future. Okay, I'm just seeing if we get lots of kind of similar but well thought out responses here. So thanks for these. I'm seeing several people mentioning obviously compliance with regulatory requirements as well as being important. So of course, that's a really important thing to keep an eye to here and an understandable driver. Making the planet safe in the long run. Yes, I think that's fantastic if we can try to make sure we keep that impact focus in mind alongside meeting those investor data needs. Okay, measuring and improving performance has been mentioned, aligning maybe with global best practices, perhaps aiming to improve your company's reputation as well. Excellent. And kind of meeting different shareholder requirements. Great. I think you can also scroll through these in Menti too, so feel free to have a look and see what others have thought. I think there's a lot of common themes, so hopefully good encouragement that we're in good company with others having similar objectives. I see someone here has also mentioned avoiding greenwash. Exactly, I think, using these standards and reporting in a robust, consistent manner, is a key aspect of being transparent and avoiding reporting that cherry picks or just provides good news stories. Okay, great. No, thanks everyone for reflecting on that point. I think what we find helpful here really is just to have that clarity about what you're aiming to get out of this and to communicate that to your colleagues as well. I think, there can sometimes be a misconception here that we're just trying to tick boxes, but I think really being able to demonstrate the other benefits that your organization can get from sustainability reporting at outset is really valuable. Okay, fantastic. So that brings us to the wrap up, as you said, on module 1, and I'll hand back to Vanessa to start us on module 2.
Okay, thank you, Fiona. So now that we have introduced the initial concepts, so let's dive into how to apply the ISSB standards. I can see in the questions tab, like there are a few questions about how and when. So to how to apply the ISSB standards, we need to take into account additional disclosures, including and relevant geological or sectoral requirements, as well as the peer practices and your leadership's objectives. So moving on, in order to understand how to ensure your disclosures meet the global standards, we will look at 2 key concepts in this unit. The first one, and the main focus of this unit, will be on how to apply the standards to achieve a global baseline for disclosure. And once we cover that, we will also discuss how additional disclosures fit. To begin with, let's focus first on how to apply the ISSB standards as the global baseline. As we mentioned earlier before, there were 4 pillars in our ISSB standards. And let's get started on the first core pillar. So the governance. So this includes aspects that relates to your governance body in your company and how management is applied. So in simple words, it's how you can win your buy-in from your leadership. Because I can see one of the questions asked in the question tab, how can we ensure that sustainability work is not only our ESG team, but also spreading over to the cross function. So it's important to know that we need to build up a very fundamental governance structure in our governance. So to start with, for each of the core content area, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements. For example, as of part of your gap analysis. So if we look at the governance and management requirements, we can see that they were fairly qualitative. For example, we will be having like similar questions like, first one, which bodies are responsible for the oversight and management of the process and controls and procedures of sustainability related risk and opportunities. For example, is management responsibly dedicated to a specific role or committee, or do a company already have set up like a ESG or sustainability committee? And the second question we will be faced is how and when do the leadership get informed about sustainability related risk and opportunities? And the third question is how these issues inform strategy, decision making, and risk management. This could include setting targets to manage sustainability related risk and opportunities. And the fourth question is whether progress against these targets link to the executive KPI. So for more information, you can make use of this SSE checklist too. But remember, it's not a replacement for reading and using the full ISSB standards. So let's take a look at a couple examples of this and what we mean in the business case. So let me hand over to Lewis.
Thank you, Vanessa. And the first governance model example we're going to look at is from a company called Yara. And Yara is a global crop nutrition company, very big company. It's got 17,000 employees and operates in 60 countries. Now, there's a lot on this slide, but what it tells us is that there's a highly integrated governance model for sustainability in this company. The sustainability governance team, which you can see in the middle line there, the middle light green lines, they report directly to the Chief Financial Officer, and they are responsible for sustainability performance and reporting. The arrows on this slide indicate the disclosure, that the flow of information between different governance bodies in the organization. You can see from the light green boxes in the middle that the information flows from different departments: human resources, ethics and compliance, global climate and energy, corporate affairs, and so on. So do have a study of this example to see how information flows, how responsibility is managed through the sustainability governance team to the CFO, right up to the board, and also how oversight, reporting lines and competencies are managed. Actually, Joshua asked us a question about this in the Q&A box earlier about how we ensure that responsibility for sustainability reporting is embedded across different functions. And I think this is an example of one possible answer to that question. Let's have another example now, and this comes from Toyota, which I'm sure you all know is a car manufacturer, including hybrid electric vehicles. This is an extract from their 2024 annual report, and it's explaining the role of the Sustainability Committee within the company's governance structure. So the Sustainability Committee is one of the business execution committees, and it reports direct to the President and Board of Directors. So what we see in this extract is the frequency with which the Sustainability Committee meets, and that's once a year or more as necessary. We see who they report to, and in this case, it's the executive in charge of enterprise risk and compliance management. So we saw Yara, the responsibility is to the CFO. In this case, it's for enterprise risk and compliance management. You can see the members of the committee come from lots of different parts of the organization, just as we saw with Yara. So there are people contributing from administration, human resources, accounting, environment, risk, and so on. And we also see what the agenda is for this committee in the shape of the actions that they've taken. So they've approved action plans on sustainability, encompassing CSR materiality and targets. They've determined the direction of the approach to sustainability that captures the opinions of stakeholders and social trends. So they've clearly done some outreach. And they also revised the sustainability policy. And if you look at Toyota's actual report, they give you a QR code that directs you straight to the sustainability policy. So these are just examples. There's no set way of setting up your governance model unless your jurisdiction requires you to. These are just to inspire you. Over to you, Fiona, for the next section.
Thank you, Lois. So hopefully those examples have helped to make the governance aspect reasonably clear. But in the next core content area, we're going to be looking at strategy. So strategy does have quite a few more disclosures to include than governance, but it's also really where companies can start to see the benefits from sustainability-related opportunities and being better prepared for those risks. So you can see here we have 3 high-level areas that we focus on in the strategy content area. And these are risks and opportunities, the effects of those risks, and then resilience. So we'll take a moment to look at each of those separately. So under the IFRS S1 and S2 disclosure requirements on strategy, we're looking to enable users of general purpose financial reports to understand the company's strategy for managing sustainability risks and opportunities. So if we first look at the requirements relating to sustainability related risks and opportunities, here are some of the questions that you'll be wanting to ask internally. So when we're disclosing information about risks, the information required will include a description of the effects, the time horizons under which those effects are expected, and that's where we also need to keep in mind that the financial effects could occur before the risk or opportunity itself materializes, as we talked about in the examples of the risk timeframes at the start of the session. And then the last 2 questions on this list are particularly considering climate risks. And so this aligns with requirements from S2. So for example, investors are also going to want to understand what types of risks and opportunity have been assessed. And this is where we see companies using the categories from the TCFD of physical and transition risk, which we'll go into in a bit more detail later. But both the S1 and S2 standards here include guidance to support companies in identifying and disclosing these risks and opportunities. And they also make recommendations to use industry-based guidance and the SASB standards to support that as well. So again, let's take a look at another example to help us see what this might look like. And the first example we're going to talk about now is from Mondi Group's integrated report. And Mondi Group is a multinational paper and packaging company that they operate across Europe, North America, and Africa. And in this disclosure, we're looking in particular how they've disclosed the results of their risk identification exercise. So in the left-hand extract, we can see the summary of their key business risks, and they use 4 different categories of risk for this, including strategy, financial, operational, and compliance. And then for each of the risks they've identified, they delegate who the risk owner is at the kind of strategic level, and then they also give a connection to how this risk interacts with other aspects of their strategy. And then if we look on the right-hand side of the disclosure, they've also drilled down within the strategic category at the climate change risk in more detail. And this is then where they've broken out those physical and transition risk types that we've talked about, as well as the climate-related opportunities that they might see as well. And so, as well as identifying these risks through the evaluation processes they describe in their report, Mondi also discloses the financial impact ranges for these risks that you can probably just about make out in the white area of the table on the right. And I see a few people have mentioned about the slides. I know these examples can be quite small. So just to confirm, you can access the slide handout on the web page at the link. We'll share it again in the chat, but if you go down to the bottom of that page, you can get the handout to access all of these slides and look at the reports in more detail. So yeah, that's just an example from Mondi that just shows how they've summarized those different types of risk that they've identified in quite a simple way. And we started to talk about it a bit in that disclosure example, but another aspect of the risk and opportunity identification that needs to be disclosed is bringing us back to what we talked about at the beginning, which is all around time. So you may remember that when we discussed this earlier, that time can sometimes be quite a different factor when we're talking about sustainability related disclosures, since risks may occur over a longer time frame or action might need to be taken now for longer term risks. So in the S1 and S2 standards, we're asked to identify within what time horizon any material effects are expected to occur. And this means defining what your short, medium, and long-term horizons are as an organization. And the reason that a company is asked to define this themselves is that there can be a lot of reasons why this might vary depending on the nature of your organization. So, for example, the relevant time horizons for you should think about your investment and business planning cycles, the strategic planning horizons of your organization or your industry, the lifespan of the assets, perhaps if you own assets, and even other factors such as your investors' assessment periods. So when we're thinking about time horizons, it's just important to remember that you do need to define those, and your investors won't necessarily be able to assume what short, long, and medium term means for you unless you are clear about that in your reporting. So moving on now to the second group of disclosures in the strategy category. So if you remember, the first section there was all around identifying the risks, and now we're talking around identifying and disclosing what the effects of those risks are and where we expect those to occur in the business. So to start tackling these disclosure requirements, companies will want to think about asking themselves questions such as beginning to describe the effects, understanding what their response would be to mitigate or adapt to those effects. And again, I think this is where hopefully an example can help us a little. So here we're looking at an example from the global chemical company BASF in their 2024 annual report. So this illustrates some of the projects that form part of the company's sustainability strategy, which they call winning ways. So the strategy includes supplying customers with products that contribute to sustainability through their use and also through reducing their carbon footprint. And so BASF is prioritizing projects where they can see a rising demand from customers and a willingness to pay more for sustainability products, and as well as transformation products that support their own license to operate. And so I think it's just a small summary from their reporting, but what's helpful here is that they show across the different aspects of their value chain where the sustainability aspects are playing out. So you can see upstream, they're focusing on how they work with suppliers. In their own operations, they're thinking about how to increase their use of renewable energy and having more efficient operational processes. And then when they're moving into their downstream, they're thinking around this triple S approach that they take, which is referring to sustainable solutions steering. And so thinking about how they can actually shift the market a little bit with the way that they offer their products and services. And so what they really illustrate in the example and some of the detail that sits behind it in their report is how this sustainability strategy is really integrated across their business model and how they can connect between the sustainability targets they've set, the investments they're making in their business to achieve those, and the long-term impacts they expect it to see on their financial revenues as well. And so sometimes one of the obstacles we know that companies can face when they're reporting on these effects is the level of detail that needs to be disclosed. And in that example we just looked at, we were showing pretty much mostly qualitative information and descriptions, but what about quantitative disclosures? So a company is expected to disclose both quantitative and qualitative information about these current and anticipated financial effects of sustainability risks and opportunities. However, the ISSB standards do set out criteria for when only quantitative information may be allowed. So using only qualitative information for these financial effects is permitted for a number of reasons. So firstly, if a company can't separate the effects of a climate or sustainability risk from other types of risk, or if there is a high level of measurement uncertainty. And finally, if the company themselves don't yet have the skills, capabilities, or resources to provide that quantitative information. So now we come into the last part of the strategy component. And so we've looked already at identifying the risks. We've then talked about how we think about what the effects of those risks are. And then this last part here is really thinking about preparing for those uncertainties and ensuring the company's long-term resilience into the future. And then this really gets into the practices and processes that the company has in place to assess its resilience and make the strategic adjustments that it needs to. So the disclosures here will include information on the types of assessment that have been used, and in particular, how and whether climate scenario analysis has been considered. And so the company is really asked here to assess its resilience to climate change under different scenarios and to be transparent about the inputs and assumptions that it's used in that assessment. So we're going to dive a bit deeper into scenario analysis in a moment, but some of the top line questions that you'll want to consider asking here when you're starting to disclose or prepare this information, we'll be thinking about what is the company's overall capacity to adjust or react to those risks and effects that we talked about, and how could scenarios be used to better explore that resilience. So again, a couple more examples here that might help to think about this further. So in this first example, we have Stora Enso, which is a Scandinavian forest products company. And in this diagram, they show us what their sales are projected to look like in 2030. And so Stora Enso is distinguishing here between what they expect to be their sort of business as usual activities at the moment, relating to the traditional forests and wood products, and then actually what their potential growth areas are in the long term, relating to more renewable packaging, biomaterials, and thinking about sustainable buildings too. So what we can see here is that they're starting to think about the long-term growth trajectory for their business and trying to analyze how those new areas of revenue growth could potentially offset some of the decline that they're expecting to see in their traditional business areas. And then our second example here comes from Solvay, which is a Belgian chemicals company. And here we're using this example just to show how they're reporting on financial effects. I know the detail's quite small, so I'll just summarize, and I recommend having a little read in the slide handout if you'd like to see this in more detail. What we want to highlight really in this disclosure is that in the first excerpt, they're transparent about those assumptions and methods that they've used in their climate scenario analysis. So you can see here they talk about which scenarios they've considered, which aspects of the business they've assessed, and they highlight kind of the internal experts who've worked on this with the consultants that they've used to conduct the assessment. And then the second aspect of the disclosure we have summarized on the screen is from the summary that they provide of the different financial impacts they're then expecting to see. So here they've used a qualitative scale to sort of show from a -3 to a +3 what the expected sort of magnitude and direction of the financial effect will be under both a 1.5-degree scenario and a 3-degree scenario. So you can see here that they are providing a balance between disclosing both the positive potential growth areas in their business, but also where they might see some decline in financial performance as well. Okay, so to wrap that up, we've just got a quick poll question for this section, just to test whether you understood something we talked about in a bit of detail back there. And that is around this opportunity that there might be to sometimes provide qualitative information if quantitative information can't be provided. So have a think and let us know which of these you think would be valid and acceptable reasons why a company might provide just quantitative information, or maybe a mix of just qualitative information, or a mix of qualitative and quantitative. So we talked earlier about a number of acceptable criteria in the standards when qualitative information might be allowed. And you can select more than one right answer here as well if you think more than one of these is valid. So I see a bit of a pattern emerging, but I'll give everyone a little bit longer just to have a think about that before we share the results. While I do, I'm just scrolling through the chat. I can see a few people have asked for the slides again, or can't see the detail. Just a quick reminder that those slides are available. If you scroll up in the chat, I think that link's been shared a number of times. So if you go to the web page for this event, and at the bottom of the page under resources, you'll be able to download the slides, and that will allow you then to zoom in or go back to any areas perhaps that you wanted to. Thanks, Landon, for resharing that link just now. So if you follow that link there. I know a few people have mentioned about having a break as well. So we will be taking a break in not too long. We know there's lots to cover. Obviously, if you feel that you need to refresh a little bit as we move along, please do step away, stand up, stretch. We will keep going because we have a lot of content to cover. But of course, as we said, we are recording the session and we'll make the recording available. So if you need to watch anything back after the session as well, that's fine. Okay, so I'll close the poll there. I think the number of responses has slowed a little bit, and I'll share the results. So I think the majority of you indeed got this correct, and A and B are both correct answers there. However, indeed, as most of you thought, the third option there is not a correct answer. So of course, it's important that we're providing balance and transparency. So we do need to share quantitative information if we have it, even if it's showing a negative impact on performance, because of course it's important to be transparent about any material negative financial effects to our investors. Okay, I'll stop the poll there, and that will bring us into our next section with Lois, which is going to zone in a bit more on some of the climate specific aspects of these strategy considerations.
Thank you, Fiona. Yes, as Fiona said, the strategy section is the one with the most requirements in S1 and S2. With the governance and risk management requirements, they're quite similar across S1 and S2, but for strategy, there are some particular climate-related considerations that we're going to talk you through in this next section. Now, this slide, the title TCFD to ISSB, don't worry too much about it. If you haven't used TCFD, it doesn't matter. The list I'm going to take you through applies to S2 in any event. So the disclosure requirements in S2 are broadly equivalent with TCFD, as we've said, but if you're not familiar with them, don't worry. The point of this slide is to explain some of the things you need to consider in S2 when you're thinking about climate disclosure in relation to strategy. So the first point, S2 requires a company to refer to and consider the applicability of industry-based topics, and they're set out in the industry-based guidance on implementing climate-related disclosure, which is available on the IFRS website. So this enables companies to identify what is particularly relevant about climate disclosure to their particular industry. S2 also requires information on where in the business model and value chain risks and opportunities are concentrated. So is there a particularly vulnerable area where your assets are located that is particularly subject to potential physical risk from climate change? Thirdly, The S2 requires a company to describe the effects of climate-related risks and opportunities, including how the company responds to or plans to respond to those identified risks and opportunities. And this might include giving disclosure about any transition plan you have, and we're going to talk about that in a moment. In providing disclosures about the current and anticipated effects of climate-related risks and opportunities on the company's financial position, performance, and cash flows, S2 sets out criteria for when qualitative or quantitative information is required. So, for example, disclosure of qualitative information only is permitted under some circumstances, for example, when the company cannot separately identify the effect of the climate-related risk or opportunity from other types of risks, or when the level of measurement uncertainty is so high that the quantitative information would not be useful. We're going to come back to this, so I'm just going to go over it quickly, but when preparing disclosures about the anticipated financial effects of climate-related risk and opportunity, recognizing that that can be quite difficult, S2 only requires a company to supply all reasonable and supportable information available at the reporting date without undue cost and effort, and to use an approach that is commensurate with the company's circumstances. And there's lots of information actually in Appendix B to IFRS S2 about what this means. For the purpose of determining the resilience of the company's strategy and business model to climate risk, a company is required to use climate-related scenario analysis. But bear in mind that S2 does not specify which particular scenarios or scenario a company should use. That is up to the company to decide. In terms of the information that has to be provided about the resilience of the company, S2 asks companies to disclose any significant areas of uncertainty they've considered in its assessment of resilience through scenario analysis. The standard asks for information about the company's capacity to adjust and adapt its strategy and business model over time to stay resilient, and also details about how and when climate-related scenario analysis was carried out. Now, I mentioned just a moment ago that when considering the effects of climate-related risk and a company's response to it, one of those responses might be to develop a transition plan. There's no requirement for a company to have a transition plan, but if it has one, certain information must be disclosed. So what is a transition plan? Well, that is defined in S2 as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including, for example, GHG emissions reductions plans. So let's talk about the transition plan. Because it is an aspect of the company's overall strategy, bear in mind that it should align with the company's strategy, business case, and business motivation for the transition plan, including the levers that are most economically and technologically feasible for decarbonisation activities. The transition plan could also be aligned with science, including what science says about requirements for net zero to be achieved and how carbon neutrality or Paris-aligned goals are explained or understood in terms of science. A transition plan, of course, should set long-term goals accompanied by clear mitigation and adaptation activities and targets and interim milestones to monitor progress towards those long-term goals. The transition plan should be transparent about the uncertainties associated with it, including what it is dependent upon for its success, what are the risks and challenges of executing the plan, and how any residual or unabated greenhouse gas emissions will be handled. There are sector-specific pathways set out by different organisations that explain how the transition could unfold for different industries and sectors, and they're also useful to look at when designing a transition plan. We'll look at some of those resources next. And finally, companies should consider how the transition plan will be evaluated and give it the hallmarks of credibility that are set out in different resources that explain the credibility of a transition plan. Now, talking about resources, that's what we're looking at here. So don't worry too much about the triangle on the left-hand side. All it means is that the Glasgow Finance Net Zero Initiative, GFANZ, and the work of the Transition Plan Task Force is built upon the IFRS sustainability standards to help companies to make disclosures and design transition plans. But what you really need to know here is that there's lots of guidance available. Let's start with the IFRS guidance document. It's really new. It was only issued about a month or two ago, and it has got lots of material there, leveraging what the Transition Plan Task Force did in their materials as well, about how to make transition plan disclosures. Next, we have the UN Sustainable Stock Exchange model guidance, also available on the website. Landon's giving some links to these resources here. And that provides, as well as disclosure guidance, some more practical guidance on the sorts of things you might want to consider when you design a transition plan. The GFANs we mentioned earlier, they have sectoral pathways and different expectations set out for both financial institutions and real economy companies. And of course, the Transition Plan Task Force framework and sector guidance is still available online, and that they actually have some guidance that's referred to in the SSE model guidance that's very helpful on the practical side. So some of you have asked about a break, and you'll be really glad to hear we're going to have it right now. So there's going to be a 5-minute break. Hopefully you'll hear some relaxing music. Go and get yourself a drink, have a stretch, think about any questions you'd like to ask us, and we'll see you back here in 5 minutes. Hello, everybody. Welcome back. Well, that break seemed to go very quickly, but I hope you had an opportunity for a stretch and a drink and that you're ready for the next core content area that we're focusing on today. Thank you for the lovely emojis. They're really helpful to us as presenters. So the next core content area we're going to focus on is risk management and climate-related risk. So this is about processes you use for risk management and whether and to what extent they are integrated into your overall risk profile. So let's think about this in a bit more depth. As a reminder, in the strategy content area, we were also talking about risks and opportunities, but the focus was on what risks and opportunities you had identified and how they could be expected to affect the company's prospects. This disclosure content area focuses on what process you use to identify, assess, prioritize, and monitor sustainability related risks and opportunities and whether they are integrated into your overall risk process. We saw this in some of the examples earlier, didn't we, where the I think it was BHP was thinking about how it would integrate their assessment of physical risk into their overall risk management process. So you might want to start thinking about questions, internal questions about what inputs and parameters you use for risk management, what prioritization criteria you use in terms of the nature, likelihood and magnitude of risks, what your monitoring processes are, and whether and how processes have changed since the last reporting period. So in relation to climate risk management, particular provisions of IFRS S2, they are consistent with the TCFD and with IFRS S1 on general requirements, but more detailed information is required about the input parameters used to identify risks, whether and how climate-related scenario analysis is used to inform risk identification. As we know, scenario analysis is to be used for resilience assessment, but can also inform risk identification. And again, whether and how processes have changed. And this applies equally to climate-related opportunities. So let's think of what we mean by climate-related risks. Well, luckily there is a definition of climate-related risks in the IFRS S2, and they are divided into two, which are transition risks and physical risks. So transition risks arise from efforts to transition to a lower carbon economy, and in turn, they are often categorized as policy and legal, technological, market and reputation risks. And we see some examples of these in the middle of the screen. They can relate to increased pricing of GHG emissions, more reporting obligations, exposure to litigation, costs of the transition to lower emission economies, changing customer behavior perhaps for different products and services, uncertainty in market signals, increased cost or availability of raw materials and stigmatization of certain sectors. All of these are examples of transition risks. On physical risks, these include event-driven or acute physical risks that arise from weather-related events such as storms, floods, droughts, and heat waves, which, as we know from the news, are increasing in severity and frequency. Chronic physical risks, these arise from longer-term shifts in climatic patterns, including changes in rainfall and temperature, possibly leading to sea level rise, reduced water availability and quality, biodiversity loss, and changes in soil productivity. Again, we see some examples at the bottom of the screen in the middle about changing weather patterns. Now, in all cases, these types of transition and physical risks can give rise to financial effects affecting the company's cash flows, access to finance, and cost of capital. And those effects can be felt over different time horizons, the short, medium, and long term. So when thinking about climate-related risk, you need to think about the definition, your process, examples, and what financial effects could arise from those risks. Similar considerations apply to opportunities, and again we have a definition in S2. Climate-related opportunities, of course, referring to potential positive effects arising from climate change for a company. And these types of effects could be because the company has an opportunity to improve resource efficiency across the whole value chain, to use lower emission sources of energy, possibly cheaper sources of energy, to use or encourage supportive policy incentives that encourage responses to climate change to elicit sustainable outcomes, use of new technologies, access to new markets, differentiating yourself from your competitors in terms of the product and service offering you have, and perhaps substituting or diversifying the resources that you use. And again, all of these opportunities can manifest in financial effects affecting the company's cash flows, access to finance, and cost of capital. And those effects can manifest over different time horizons. Let's have a look at an example. And this example is from a company called the RS Group, which is a UK-based distributor of electrical and industrial equipment. It has got global operations as well. So, of course, this is just an extract from their reporting on climate-related risks and opportunities. And elsewhere in the report, they've identified 10 principal risks, including climate-related transition and physical risks to their business. And this extract just describes some of the physical risks. So the most significant physical risks identified by this company relate to the impact of extreme heat on their distribution centers and the potential for extreme weather events to cause physical damage and disruption to their customer supply operations. And you can see that in the two lines. The first line is about the risk to distribution sites from extreme heat, and the second line, the risk from extreme weather. Now, in each case, you see this little red wheel that shows how the risk relates to their strategic actions. So this is an example of connectivity we talked about earlier. And you can also see how the connection of the risk or opportunity relates to their stakeholders, signified by these little dots. So again, an example of connectivity and integration. In this example, the company describes the risk in the second column. I won't go into that in the interest of time. They tell us which business owner within the business owns the risk and manages the metrics or other processes used to monitor and manage the risk. They give us information about the metrics they use to monitor the progress of the risk, and also what initiatives they're undertaking to manage the risk and adapt to the risk, including their capital investments and what is their focus for future years to manage these risks. So we can see the process that they're using there and who owns that process, and that it's related to the types of physical risk they identify. So we're going back to Vanessa now, who's going to take us through the next core content area.
Okay, thank you, Nui. Now we will now spend some time reviewing the final pillar, the final core content area of the standards, which is metrics and targets. And let's start with the metrics first. So the requirements on the metrics are designed to enable investors to understand a company's performance in relation to its sustainability-related risks and opportunities. So preparers should disclose information explaining how the metrics are defined if they are absolute or relative, if they have been validated by a third party, as well as the methodology, such as what is the method of calculation, and what were the inputs, what were the parameters, are there any limitations, or what assumptions are involved in disclosing the metrics. And then let's move on to the second part of this category, the targets. The requirements on the targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals. So the disclosures include, firstly, whether they are qualitative or quantitative targets, or whether it is set voluntarily or by the law or the regulation. And secondly, the metric used to set the targets and to monitor progress towards its achievement. And also, we need to disclose the baseline period from which progress is measured and the period to which the target applied. And thirdly, what are the milestones on the interim targets? And lastly, if there have been any revisions to the targets, together with an explanation about the revisions. So let me invite Louis for bringing us an example.
Thank you, Vanessa. And this example is from a company called CLP. It's one of the largest investor-owned power businesses in Asia Pacific, and it aims to be a leading responsible power provider. This is an extract from its 2024 sustainability report, and you'll have noticed that lots of the examples we've shown you up to now have been about climate, but this one is about how the company manages waste management and material use. So they also give us the metrics that they use for this, including the percentage of pollution the company reduces through recycling and removal activities. Now, we've talked a lot about connectivity today, but the metrics the company is showing us in the bottom panel about their pollution reduction and waste management are actually set within the context of the company's strategy. So they tell us at the top about the medium and long-term waste management targets they have, but also their circular economy and waste strategies. So how did they calculate these metrics? Well, you'll see in the pale grey writing on the top left panel that they refer to SASB standards and also GRI standards. And so they're disclosing the frameworks they've used for the calculation of their waste management and material use metrics. They compare their 2024 progress here with the 2021 baseline, but also they're setting targets for this is all set within the context of the targets they've set for 2025 in accordance with their strategy. So there's quite a lot here that tells us about the overall business strategy, the specific targets for waste, how they're calculated using SASB and GRI standards, and also how these interim targets relate to the target they've set by 2025 and by the end of 2030. So with that example, I'll hand back to you now, Vanessa.
Okay, thank you. So now let's talk more about some of the climate-specific considerations for disclosures on metrics and targets. As we mentioned earlier before, the TCFD framework included recommended disclosures, and which IFRS S2 builds on and S2 as part of a required disclosures. So, for example, IFRS S2 requires disclosure of industry-based metrics relevant to a company's business model and activities. And also, additional disclosures are required on GHG emissions, including separate disclosures for the consolidated accounting group and associated joint ventures, and information about the company's financed emissions. And in addition, IFRS S2 sets out a scope-free carbon emission measurement framework to provide guidance for preparing scope-free GHG emissions disclosures. So while IFRS S2 does not explicitly require a company to disaggregate to its GHG emissions disclosures by the constituted gas, IFRS S1 includes requirements on disaggregation that would result in the disclosure of the constituted gases being required if such disaggregation provides material information. So I would like to remind everyone that you can access more information on the climate metrics in the SSE's training tool on this topic, and we will later share the link in the chats, and you can also find it on the SSE's website. And likewise, there are also some additional disclosures compared to the DCFD when we talk about the targets. For example, IFRS S2 requires disclosures about how the latest international agreement on climate change has informed the targets and whether the targets has been validated by a third party. And secondly, IFRS S2 also requires disclosure of more detailed information on GHG emission targets, including additional information about any planned use of carbon credits to achieve a company's net GHG emission targets. And lastly, IFRS S2 also includes additional requirements to disclose information about the approach to setting and reviewing each targets and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. And the questions on GHG emissions often come up in our previous training sections on the metrics and targets. So we wanted to address some of this briefly. For those who might not be familiar with the scopes of the GHG emissions, we will highlight them here. So scope 1 GHG emission includes all direct emissions that occur from the sources owned or controlled by your own company, such as the emissions from your company's facilities or vehicles. So your consumption of the diesel or the oil. And the scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And the scope 3 is then all other indirect emissions that occur in the company's value chain, including your upstream and your downstream. And the S2 requires a company to disclose its absolute gross scope 1, scope 2, and scope 3 GHG emissions in accordance with the GHG Protocol corporate standards, unless jurisdictions require a company to use a different approach or different standard to measure the GHG emission. If a company is using a different measurement method apart from the GHG Protocol corporate standard, there is a transition relief to use that method in its first year of applying the standard, and whether and how the company is using an internal price on carbon for decision making, and also the S2 requires the company to disclose whether and how executive KPIs link to the climate change. So on May the 29th of 2025, like just a few months earlier, IFRS Foundations has published new educational material, and it presented in a Q&A format, detailing the greenhouse gas emissions disclosure requirements under the IFRS S2, including the measurements, the use of the GHG protocol, and how to report scope 1, 2, and scope 3 emissions in line with the standards. So if any of you are interested in it, I strongly recommend you to take a further look. So let me hand back to Louis for the example.
Thank you, Vanessa. And this example about greenhouse gas emissions disclosure is from a company called Enel, which is an Italian company that produces and distributes electricity and gas. This is an extract from their 2024 GHG inventory. So they publish a separate report setting out their greenhouse gas emissions. And it starts with a description of the company's ambition to achieve net zero emissions by 2040 and to promote energy generation from renewable sources. So again, we see that connection between the strategy and the metrics which we're going to look at now. At the top of the slide, you can see the company's carbon footprint, and it's broken down by scope 1, 2, and 3 that Vanessa's just explained to us. And we also see there's a comparison between the 2022 base year for measuring emissions and 2024. So the 2024 results are in the dark blue boxes or graph bars, and 2022 in the shaded bars. So immediately you can see that generally there has been a reduction in greenhouse gas emissions across all three scopes, but you can also see what is the biggest source of greenhouse gas emissions, and that is scope 3 emissions. So this clever use of a graph can show us quite a lot about which scope the emissions relate to, what is the trend over time, and where the most emissions are from. At the bottom of the slide, we can see an extract from the way in which the company breaks down its scope 2 emissions. So scope 2, as we know, from the emissions associated with the purchase of electricity, generally speaking. So how do they break down or disaggregate this to give greater insight to their readers and investors? First, they break it down by business activity. So in this case, the activity is power generation and other activities, which are power distribution and real estate management. They also break down the emissions by source. So the sources are from the grid in power plants, and from electricity consumption from the grid in terminal ports at particular locations. They also break down the emissions by years, as we've also seen, comparing 2024 and 2022, but they also break down these emissions by calculation method. This only applies to scope 2, by the way. There's the location-based calculation method, which reflects average emissions intensity of the local electricity grid that the company is connected to, and the market-based calculation method reflects emissions from electricity based on the contractual terms that the company has. So quite a lot of information in too little illustrations there. And of course, the disaggregation is used to give greater detail, really, to readers about the source of emissions. Let's do a little poll now, and this poll, I'll give you some time to think about it, is what is the objective of the requirements on metrics in standards S1 and S2? Is it to enable report users to understand performance in relation to the company's sustainability-related risks and opportunities, understand progress towards targets, or to understand the company's assumptions for the future? I really want to give you time to think about this, but we're running a little bit behind time now. So I'm going to end the poll and share the results. And this is great. Good news. Most of you are correct. The correct answer is A and B. Now, those of you that answered C might say, well, of course, objectives help people to understand the company's assumptions for the future. And you're right. The reason we ask the question this way is to encourage you to read the standards themselves. And in particular, in this case, to refer to paragraph 45 of IFRS S1, because at the beginning of each of the core content areas, the standard sets out what is the objective of the requirements. And this helps you really to craft your disclosures, to think what exactly is it that the requirements want, and how can I be very precise in my response. So paragraph 45 does say the objective of the metrics requirements is to understand the company's performance in relation to its sustainability related risks and opportunities, and understand progress towards any targets. So C is not wrong, but it's not exactly what the standard requires. So do read the standard. We're going to move on now to the next part of the Align module, which is about how you integrate disclosure requirements that you might be required to respond to with the ISSB requirements. And some of you have asked about this in the chat as well, and in the Q&A section. So we've already talked about this, and I'll go through it quite quickly. You might have to respond to sustainability disclosure requirements in addition to IFRS S1 because you're building on the baseline that we described earlier. And this might be because there are listing requirements that apply to you. There might be policy objectives that you want to respond to or take advantage of, like securing incentives for sustainable practices. You might want to build on the baseline by providing additional information because of industry standards that apply to you, or because you want to respond to wider stakeholder needs, i.e. wider than just your investors. We've talked already a bit about this, and Tony mentioned it at the beginning, that the ISSB is making progress towards the adoption or use of ISSB in a number of jurisdictions. As at June 2025, 36 jurisdictions have adopted, used, or are finalising the adoption of ISSB standards. And the ISSB has issued some profile guides that show the progress of their engagement on adoption in various jurisdictions. And if you want to know more, there are some resources linked here that you can refer to about the IFRS jurisdiction sustainability consultations, the regulatory implementation programme, and the roadmap development tool. I've seen also some of you ask in the Q&A about interoperability. As at today, although there's a lot of simplification and harmonisation that we talked about earlier, there are still different standards or frameworks to which you might want to or have to respond. I'll just go through this quickly because we've already talked about it. We know that CDP has aligned its questionnaire on climate with IFRS S2. We know that the Transition Plan Task Force disclosure-related materials have been taken into the IFRS Foundation. So let's just focus on the GHG protocol. And this is the protocol that must be used for the calculation of greenhouse gas emissions under the ISSB. And the point to mention here is that strategically, ISSB is working with the GHG protocol team, both in terms of governance arrangements, but also engaged in technical updates to the GHG protocol standard. And the other one to mention, we haven't mentioned before, is that the ISSB is considering how to build upon the recommendations of the Task Force on nature-related financial disclosures as it progresses its work plan on biodiversity and ecosystem services. So we've already mentioned that ISSB and GRI have they do plenty of work together. The most important thing to note at the moment is that on the 26th of June, the GRI's standard setting board granted equivalence to IFRS S2 climate-related disclosures for scope 1, 2, and 3 emissions. And what this means is that whether you are calculating GHG emissions for GRI or for ISSB, they will be regarded as equivalent. And that's a very sort of major and helpful streamlining agreement from the GRI and the IFRS Foundation. We also know that through their collaborative efforts, the GRI and ISSB are committed to delivering full interoperability with the GRI's 101 biodiversity standard as the ISSB's project and biodiversity ecosystems and ecosystem services develop. And in addition to all this technical work, there is some other types of collaboration, such as the IFRS Foundation being a convening partner of GRI's Sustainability Innovation Lab in Singapore. So lots of collaboration between ISSB and GRI. Now, Perhaps not so much for this audience, but some of you may be aware and affected by the fact that in Europe we have the Corporate Reporting Sustainability Directive that requires certain companies to make sustainability disclosures according to European Sustainability Reporting Standards, ESRS. Now, I won't go into this in detail because, as you might know, there's some simplification work going on in Europe, but the message to take from this slide is that the IFRS Foundation works with the European standard setter called EFRAG to ensure as much interoperability as possible. They've already found that there's a high degree of alignment between their respective standards on climate-related disclosure, and if and to the extent that there are differences, it's mainly because the European standards are designed to elicit information for a wider stakeholder group than investors. Integrated reporting. I think at the beginning we saw from the Zoom poll that some of you are using integrated reporting, and the Integrated Reporting Council is one of the organizations that was consolidated into the ISSB back in 2022. But the integrated reporting framework still exists and is regarded as a complementary tool for investor-focused communications that respond to IFRS S1 and S2. So all I want to say about this particular slide is that there is this guide to using integrated reporting to help support your sustainability reporting and provide a more holistic view of the value creation process. In this document, you'll find a dedicated frequently asked questions section, a mapping tool, and a guide to getting started on integrated reporting. And what's particularly relevant here is a number of you have asked about, should we start with process or reporting lines? How do we make sure that sustainability reporting responsibilities are embedded across the organization? This is where I think that integrated reporting can be of real help. So those of you that are interested in embedding sustainability reporting activity into the organization, maybe take a look at this. But finally, on this point, of course, integrated reporting is underpinned by integrated thinking, as I'm sure many of this audience will know, and that can really enhance the quality of a company's corporate governance. Let's do one more little Zoom poll here, or shall yes. And this Zoom poll asks, in considering your disclosure objectives, should you consider the ISSB standards only, ISSB standards and regulatory requirements, just regulatory requirements, or all of the above and other sources of guidance? You can only pick one answer here. I can see that you all know the answer to this question, so I'm going to share the results. Of course, you're absolutely right. Well done. It's all of the above. The ISSB standards, regulatory requirements, and other sources of guidance can help with responding to doing your sustainability disclosures, and we've seen that from some of the examples, haven't we? So I'm going to hand back to Fiona now for a summary of Module 2.
Great, thank you so much, Lois. So this wraps us up now on Module 2. And you might be thinking, we've been going for 2 hours now and we're only halfway through. Don't worry, Module 2 is very much the largest section of the content. So we're well more than halfway through the material, you'll be pleased to know. But I'm sure you'll agree there was a lot to cover in terms of the content in this aspect. So here we reviewed all 4 of the core content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. And I think an important thing for us to remember here is that, of course, these aspects don't operate in silos. And we saw in those example disclosures that we looked at from companies that despite having 4 separate categories of information, of course, in reality, these are all interconnected. And we also discussed how your disclosure might go beyond the requirements of S1 and S2 to meet the needs of different stakeholders, for example, or to meet regulatory requirements in certain jurisdictions, or maybe industry standards as well. So what's important to remember when we're doing this is that the ISSB standards have been purposely developed to act as a baseline. And then the building blocks approach allows you to, as a report preparer, add additional disclosures on top if you choose to do so. But if you do choose to take that approach, what you also need to be careful about is not to obscure the requirements of S1 and S2 for your investor audience. Okay, so to wrap us up on this section, we have another quick Menti activity that we'll do together. And the purpose of this activity is really to start to think, now we've heard a lot about the content that you need to develop and the disclosure requirements, get you to reflect a bit on what you think your key gaps might be aligned to those requirements. So this could both be gaps in your current disclosures and the content that you report, or maybe it's also gaps in your internal processes, if you think you need to develop new processes to support you here. And so what we're trying to get the thinking started on here is really just to prioritize and identify what those gaps are. And what we'd really recommend that you do outside of the session is to, of course, conduct a more structured gap analysis. So we've got a checklist that we've included in the homework assignment and a number of resources that we've shared, such as our disclosure gap analysis checklist that can support you with this. But really, this is about getting your head around, what are the additional requirements that you might need to report versus what you're doing currently? What are the different skill sets and resources that you might need to support you with this? And having a clear plan for how you're going to address those gaps. So we'll move into Menti now, just have a reflect on that point together. So we've shared the link again with you in the chat, and I'll share screens again so that we can look at your responses. So of course, probably there may be more than one gap here. So feel free to share more than one option if you have, or just think about what your kind of top priority issue that's coming to mind for you might be to address, and hopefully just a good point to reflect on what that is. Okay, so a few people have already come back to us, which is fantastic. So we're seeing a few different things. Someone has mentioned having maybe enough integrity in their reporting. So maybe that's a bit around the robustness and the stringency of the processes that you're using at the moment, and maybe a need to increase that maturity there as we're moving towards these more prescriptive and regulated requirements. Someone's mentioned maybe having gaps against the specifics of S1 and S2, which of course is very likely considering these are the newer standards that we're aligning to now. As we've covered, hopefully when you start to look at S1 and S2, you will see that actually a lot of the requirements draw from what already existed in the market. So hopefully those gaps may not actually be that substantive and just a different way of framing things. But encourage you to look at those mapping resources and the gap analysis checklist that we've shared to help you there. Some people have mentioned maybe around the limitations of sector-specific metrics, maybe not having a consistent materiality assessment, needing to do scenario analysis, maybe needing to think about data integration into financial reporting. I think that last aspect in particular is something we often see highlighted. Is that being a different or new aspect for many companies here, needing to connect financial and sustainability information more fully. And so, whether you're a financial colleague or a sustainability one, I think talking to each other and thinking about this in a shared way and how you can develop an approach that serves both technical disciplines is really important. Thinking about making our reporting clearer and easier to understand for all audiences, not just specialists. Yes, actually, I think that's a great thing to highlight. We'll need to balance between having that technical detail for those stakeholders who want to see it, but also ensuring that we have kind of accessible and clear summaries and concise information for, in particular, our investors. So I'm just having a look and seeing what else is coming through, maybe any new points that we haven't discussed yet. I see maybe having a knowledge gap internally. Yeah, I think perhaps you're referring to there the need to sort of upskill your colleagues on this topic, which of course is very common and often a good starting point here. And we hope things like today's training and sharing the resources that you get from today with your colleagues can support you with that. We have some resources at the end that we'll share regarding the IFRS's e-learning as well, that maybe is a good thing to share with your colleagues to support them in upskilling there. We talked about maybe having governance gaps here, so maybe getting the right governance in place with your board and executive committee. It's often common that they have some sort of remit already with regards to sustainability, but perhaps it's not in the same level of depth as we might need them to see now, and the level of scrutiny that they need to provide might need to grow. This is something that the SSE are actually currently developing guidance on, relating to the role of boards in the ISSB. So stay tuned for that guidance later in the year. And then we've seen a few different options coming through here, maybe needing to think more about data collection processes and setting up the right ownership in terms of having kind of accurate and measurable integrity of data. So indeed, often, as we talked about how we can start to quantify the financial effects of sustainability risks and opportunities, that brings in stronger requirements there for more data robustness. So I think that's also a very common area for many organizations to be focusing on here. Okay, just see if we can see anything jumping out that sounds different. Maybe some people have mentioned a few of the climate specific aspects around needing to think more about their energy and emissions data, maybe starting with scenario analysis and thinking about your broader scope of emissions in scope 2 and 3 beyond your direct operational emissions. So yeah, I think this is great. It's really just a quick opportunity to reflect on what's coming to mind for everyone as your sort of key gap here, just to keep a bit of a record of that for yourself and reflect on what you're hearing. So yeah, hopefully just a good starting point to have a think about that, and maybe encouraging as well to see that you have many colleagues who are grappling with the same challenges and barriers that you might be doing as well. So I think we've really covered a lot of what we would identify here as some of the key areas many organizations will need to focus on. Perhaps as well, one that I would highlight, it may have been mentioned, but I didn't see it, is in the past, you may perhaps have had a separate sustainability report. And as we'll talk about later in the Communicate module, a key aspect of the IFRS standards is integrating this information into your annual reporting. So thinking about how you can integrate this information is often a new thing to consider as well. But really overall, what we'd recommend is kind of taking away these gaps, really thinking about the priorities here. So which would be the most significant gaps that you should try to address before your first S1 or S2 disclosure? And then maybe perhaps there are some aspects that you can improve and deprioritize and maybe improve over time as your reporting evolves. So just keeping that balance in mind. Okay, brilliant. So I'll take us back to the slides now, and we'll be getting started on the implement module, which I believe Lois will be getting us started with.
Yes, thank you, Fiona. So implementation. This is different from what we've been talking about. We've been talking about the content required for disclosure, so what the standards require you to disclose. But now we're looking a bit more at the practicalities about how you can prepare for disclosure and how you can develop practices and processes needed to collect the appropriate data for disclosure. This is covered to some extent in the standard, but of course the standards are designed for disclosure, not so much the practicalities. So that's why we're trying to help with it here. There'll be three aspects to what we cover in the implement module. First of all, how to identify risks and opportunities. Secondly, what sort of evaluation processes you might want to undertake in-house. And thirdly, the integration of sustainability disclosure practices into your own processes. And there's some good news on that one, so stay tuned for integrate. First of all, identifying sustainability related risks and opportunities. How is this done? Well, the standards do offer some guidance for this. Now, bear in mind that IFRS S1 asks companies to provide material information on all sustainability-related risks and opportunities that could reasonably be expected to affect the company's prospects. And S2 sets out the requirements for climate disclosures, as we know. But what about risks and opportunities beyond climate? There's currently no standard for ecosystem services, for example, or water management, or as we saw from the CLP example, from waste management. So what should you do? Well, S1, I think this is around paragraph 50, directs companies to sources of guidance to support the identification of risks and opportunities other than climate, and information to disclose about those other risks and opportunities. So what it says is, a company shall consider the SASB standards. So these are industry-based standards that help you to identify the topics and metrics that might be most relevant and the risks and opportunities that might be most relevant for your industry. So I'll give you an example. With household and personal products companies, they will often produce things like cleaning detergents, soaps, and cleaning supplies, that type of thing. So the SASB standards and actually the industry-based guidance for climate disclosures, they will ask a company, for example, what is the amount of palm oil you've sourced and where did you get it from? Is it from an accredited source? So the SASB standards must be considered in preparing in identifying your risks and opportunities. And a company may also consider IFRS educational material. We've already heard about some of it, and there's some very extensive educational material on how to identify sustainability related risks and opportunities and material information about them. You can look at the CDSB framework application guidance that's available from the IFRS website, and that covers a number of subjects, including water, nature, social practices. You might also look to resources issued by any industry bodies to which your sector belongs, and the materials of other investor-focused standard setters. Now, on the other side of the screen, we see, well, which information should you disclose? In fact, the same sources of information should be used to determine what information you disclose. But in addition, you can look at GRI standards and the European Sustainability Reporting Standards. So again, the CLP example we looked at earlier is a good example of this, because we see them looking at SASB and GRI standards for the calculation and determination of their waste management and pollution strategy. So let's have a look at an example now, and this is an example from a company called Ayala, and they're a big conglomerate company based in the Philippines, and it shows the process that they use for identifying risks and opportunities. So not so much looking at this, they would look at the sources I think we've just referred to, but this shows their internal process. Just briefly, they start with a communication and consultation exercise to work out, what inputs and insights they need to inform their understanding of risk. When we looked at the Toyota example earlier, we saw that their sustainability team had conducted some external engagement to do just this as well. So it seems to be a common practice. Then in the first of their 4-point step, Ayala looks at the context for understanding their risk. So this involves looking at internal and external factors that inform their risk assessment. They then go on to the assessment by identifying, analysing and evaluating their risks. Perhaps they don't say here, but perhaps could also look at the SASB standards for their different sectors. Thirdly, they decide how to treat risks, and who will own the risk that they've identified in order to treat it appropriately. And finally, they have a monitoring and review process. So their material sustainability topics are all dealt with through this risk process. Let's have a look at another example now of a company that takes a slightly different approach. This company is Nest. It's from their 2024 annual report, and Nest is Based in Finland, it's a leading producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. This extract comes from the climate section of their annual report, and it shows how they identify risks and opportunities in 2 different scenarios under a time horizon until 2050. So although we know scenario analysis is primarily used for resilience assessment, here it's also being used to help understand how risks might unfold in future. So the net zero world is actually divided into 2. They look at it on a global basis and also for Europe and North America. And they do this because some economies may take action at a faster pace than others. But in both cases, they anticipate opportunities for growing demand for renewable and circular solutions. On a global basis, they think that they can expand into new markets and sectors. In the EU and US or North America, they expect their supply of renewable and circular solutions to be supported by regulatory and voluntary ambitions. So that's on the opportunity side. On the risk side, they see that there can be risks from competition and acceleration of new technologies. In the compromised climate scenario, climate action in this scenario is slow. Global warming of between 2.5 and 3 degrees is expected. In this case, the company's opportunities are to differentiate itself from others by offering renewable and circular solutions. But the risk is that the demand for products might be constrained in this world without the relevant support. In both cases, we see that the company is given an indicative financial impact, and the most positive impact is in the net zero world 2050. And perhaps we should expect that because this is a company focused on the development of renewable fuels and circular products. So it shows that the company and the world are developing at the same pace and in the same direction. Now, we've talked about this a bit already, so I won't go into it in detail, but the standards, ISSB standards, recognise that it can be difficult to identify your sustainability related risks and opportunities. And therefore, to ensure that the effort is proportionate to the benefit, the standards say that in applying the requirements on risks and opportunities, companies shall use all information available to it at the reporting date without undue cost and effort. But at the same time, the companies are required to use all reasonable and supportable information to assess and disclose those risks. So what does this mean? Well, reasonable and supportable information is specific to the company. So these are things the company should know already. It takes account of the external environment, and we saw that in the Ayala example, didn't we? They'd established that through the first step of their process and through external engagement. It includes information about past events and current conditions, and of course the company will already know that, but also forecasts, perhaps like Nest using scenario analysis to inform those forecasts. And in some cases, what is reasonable and supportable is specified by the ISSB standards. So we've covered the first part of this module, and I'm going to hand over to Fiona for the evaluation section.
Great, thank you, Lois. Okay, so as we've said there, once those risks and opportunities have been identified, companies will then need to evaluate the financial effect of those risks and opportunities. And we know this can often be a daunting task, so we're going to try and unpack a few of the concepts here. So here S2 is asking companies to disclose information about the implications of climate change on its strategy and business model, and its overall financial and operational capacity to adjust over the short, medium and long term and adapt to these risks. And so here, this is where you would want to look at your resilience and use the concepts of scenario analysis to analyze what those effects will be and how you expect to be able to respond to those uncertainties. So when we're introducing scenario analysis, it's important to clarify here that we're not asking for you to predict the future or forecast what's going to happen. This is really just an opportunity to project and consider what is a plausible possibility in the future. So it's a tool to test your resilience to different possible pathways, not necessarily to ascribe which one you think is going to be the most likely. And overall, the ask within S2 here is to use relevant scenarios and select those which make sense for your business, and then to disclose information about the assumptions and methods that you've used for that assessment. So we'll have a look at an example here to see how this could look in practice. So this example is coming from Nestlé, the Swiss food and drinks company that you're probably familiar with. And this output we're seeing on the screen is just one of the summaries that comes from the detail within their statements on their climate scenario analysis. And the visual we're looking at here shows the projected potential impact of physical climate changes on the yields of 12 of their key agricultural commodities. And this projection in particular is for 2040 under a medium emissions scenario. And then in the metrics side of what they're showing here, what they're showing is the percentage potential change, positive or negative, in crop yields compared to a baseline of 2022. So you'll see in some parts of the world, probably more commonly than not, they're expecting to see a decline in their yields. In some areas, they may be expecting no change. In a few, they're actually expecting an increase. And so the analysis shows that really changing weather patterns, both in terms of chronic events such as rainfall and temperature, and both acute events like heat waves and drought and water stress, could ultimately lead to more volatility in their yields of different crops. And then that in turn is going to potentially affect the stability of their supply chain and their prices as well. And so in the disclosure, they go on to provide some more detail about how they're trying to take steps to improve their resilience based on this analysis. So, for example, they're looking at product innovation, operational efficiencies, and maybe investing more in R&D and leveraging crop science to help them manage these risks. So, of course, when we're talking about anticipating the materiality of future events, that can be very challenging. And so to help with this determination, the S1 standard asks you to think about a number of different issues that could help you to determine this. So there's a list on the screen here of these different factors that you should consider when you're coming to this judgment about overall how uncertain are your assessments and how are you kind of monitoring those changing uncertainties. And so, for example, companies are asked to think about both low probability and high impact outcomes here. So not just thinking about what's most likely, but what is feasible in a wide range of possibilities. And really, these uncertainties are something that companies need to continue to evaluate and to reassess at each reporting period and aim to provide that transparency on. Okay, back again to you, Lois, for the integrate section.
Thank you, Fiona. So this is the third concept we wanted to discuss with you about developing new process or perhaps integrating sustainability disclosure into your existing processes. And I promised you some good news. And the good news is you may have a lot of what you already need within your organization to help with your sustainability disclosures. So when you're thinking about whether you need new processes or can use existing systems and processes for disclosure, of course, you may want to conduct a gap analysis. And I've seen you've already raised that in the Menti sessions that we've had. When considering the existing processes, they need to be evaluated to check that they're suitable for identifying and dealing with sustainability-related risks and opportunities. And for example, the prioritization criteria you use, if they're just things like probability and likelihood, may not be sufficient because of the particular characteristics of sustainability-related risks and the timeframes over which they manifest. So you might want to include other prioritization criteria on top of your existing ones, such as vulnerability and speed of onset. Your existing controls, internal controls processes need to be evaluated to see if they are applicable to sustainability disclosure. And importantly, you'll need to think about which departments and which people have relevant processes and expertise to contribute to your sustainability disclosure. Where are they? Who are they? What are those processes and how can they be used? You also need to think about the interconnections between different internal and external factors and how they affect your understanding of sustainability disclosure. We've already seen that, haven't we, in a few of the examples. You'll need to think about what uncertainties affect your disclosures and your understanding of risks and opportunities, and what your approach is going to be to those uncertainties and how you'll manage them, including the management of assumptions. And you'll need to think what resources you have in place or might need for the development of existing systems or perhaps new ones. So you might have a budget or change management process that you need to go through in order to get those amendments to your existing systems or develop new ones. So what we've mentioned to you already, the non-mandatory homework that we suggest for you is to develop a disclosure plan. Now, a disclosure plan is what we describe as a standalone strategy or part of a wider disclosure strategy that helps you to sort of plan and design your sustainability disclosure. So one thing it does is help you take control of your narrative. What do we mean by that? Well, you'll notice that lots of the disclosure requirements ask, what is your business's strategy? What is your business's risks and opportunities? So you could take the approach, which is not encouraged at all by the standards, of giving a generic response like climate change will affect our business. Really, having a plan that is very much focused on your business will enable you to make it much more specific and to your business, and you can take control of your narrative. A disclosure plan, which can be like a little book or a spreadsheet or something, can support internal collaboration, knowledge sharing, and cross-functional team discussions with staff by identifying who's involved, who has expertise, who have systems that can contribute. So this could include colleagues in the risk management department, company secretarial, procurement, finance, and indeed external consultants could also help, and you can record who they are, what systems they have, how they're going to be organized, perhaps on a subcommittee, and what their responsibilities will be. The disclosure plan can also help you understand how data will be sourced, whether and from whom and on what you will seek assurance, what are the sign-off procedures for information, what are the company's goals and requirements for disclosure in addition to compliance with standards and regulation, what does the company want to communicate. All of these things can be recorded in a disclosure plan, really hopefully to make your life easier, because you have this central reference point and audit trail about where and how judgments have been made about all of these issues. So let's see now an example from Novo Nordisk. Now, they don't call this a disclosure plan, they call this a basis for preparation of their sustainability statement. And Novo Nordisk is a big Danish pharmaceutical company, and in this basis for reporting, they set out a number of things. In the second paragraph, you can see all of the standards and frameworks that they use to contribute towards their reporting. So they have got IFRS S1 and S2 in there, but also the Science-Based Targets Initiative, the GHG Protocol, and local laws that apply to them. They explain the time horizons to which their sustainability statements refer. They explain what they've left out and why, how they've used estimates and assumptions and how they deal with uncertainties. And there's lots of contextual information here about how they have prepared their report. So let's have a quick poll about disclosure plans. And the question is, you can only answer yes or no. Is a disclosure plan required by the IFRS Sustainability Disclosure Plan standards? You can either answer yes, you must disclose your plan, or no, but it's a very helpful tool. I'll give you a minute to think about that. For my colleagues' reference, I'm planning to miss the next Zoom poll because we're just slightly behind on time, so hopefully okay for Fiona to go into the Module 3 summary. But let's have a look now at how we're getting on with this. I'm going to share the results. Oh, you can see you're very evenly split here. About half of you think yes, half of you think no. Well, those of you that said no are correct. There's nothing in the ISSB standards that says you must have a disclosure plan and you must disclose details about it. We just recommend that it's useful homework for all the reasons I've given you, so you have this central reference point. So don't worry that if you think you got this wrong. I can quite understand why you said yes, but I just want to point out a few things to you. In the standard itself, in paragraph 15 of IFRS S1, to give faithful representation of your information, you have to disclose any additional information that helps readers understand your report. This could be in your disclosure plan. Secondly, you need to disclose the sources of guidance you've used for your preparation. That could be in your disclosure plan. And thirdly, you need to describe what assumptions and uncertainties you're dealing with. So the standards do ask you some of these things, but we're just recommending you have this overall disclosure plan to coordinate those things. So I hope that helps. And Fiona's going to take us through the Module 3 summary now.
Great, thanks, Lois, and thanks for making that nice and clear on the benefits of a disclosure plan. As we say, we'll just skip past that poll question in the interests of time. But to wrap us up on this module, our third of 4, just as a reminder of where we're at in the format, we'll remind ourselves of a few key things. So firstly, let's come back to those connections, which is something we've come up against a few times in the training so far. So in Module 2, we wrapped up by highlighting the importance of connections between the 4 core content areas of disclosure. And then in this module, what we really learned as well is that there are many connections between a company and its external and internal environment. And really, these connections are what we should be focusing on to help us to identify key risks and opportunities in a robust manner. And then the second thing that we discussed in this module was relating to evaluating those risks and opportunities. And a key component of this evaluation being having consistency in our assumptions. So we talked about using potential tools like scenario analysis as being a helpful way to better understand and report about your resilience to risks and opportunities. But what we need to ensure that we're doing if we're using scenario analysis is that we're tracking those assumptions and we're being transparent about how we're using them. And finally, as we've seen in this module, even if some of this data isn't necessarily data that you're already disclosing, it may well already be something that you're collecting internally for different reasons. Or perhaps it is that you have new data to collect, but there are existing processes that you could adapt in order to allow you to collect that information. So as much as we can, obviously we're trying not to start from scratch here and to work with the data that we've already got. So that brings us just to our quick Menti reflection exercise that we'll be doing to end this module. And this is just thinking about those potential data processes and data collection systems. So as we've said, we hope that there's a lot that you can already use that exists within your organizations. And what we just want to take a quick reflection on tomorrow together is what are those data collection tools that you might be able to use? What are the sources of information you have that could help you here to get started? So I'll give everyone a couple of moments just to share their thoughts. We'll have a look at those answers together in the Menti and see what you think. Again, no right or wrong answers with Menti. It's really just a way to allow us to reflect on what we're hearing. It's always helpful just to try and take back what we're talking about into your own organizations in a second. So we'll just have a quick moment. So yeah, as I said, it's thinking about maybe any existing processes or sources of data that you have that you could leverage here to help you in understanding sustainability risks and opportunities better. So some people have mentioned about maybe using surveys or questionnaires. It's also been mentioned around maybe using templates or digital platforms to help you. Someone in the chat mentioned maybe using field work as well. Yeah, depending on what your business operations are, that could be relevant. Some people have mentioned, of course, leveraging your financial reporting. Indeed, although we call it financial reporting, a lot of the operational information that you're already collecting for those purposes is very much interconnected with these sustainability risks and opportunities, as you've rightly identified, relating maybe to your supply chain or your stakeholders is very important here and will help you. Great. So maybe some people have mentioned using data from audits of compliance, maybe using project management tools that you already have, maybe having workshops to help you collect information from your stakeholders, looking at your operational processes and monitoring systems, and maybe having primary data as well that supports you. Great. Lots of good thoughts here. And I think lots of things we'd support there. Probably the only things I would highlight is just looking to your enterprise risk process as well. Of course, in your enterprise risk process, you likely have already identified and assessed risks that either have sustainability factors to them or that are relevant to disclose under S1 and S2. So connecting into your risk process and your risk teams is really key. And finally, I think just making sure that you're using the governance structures that you've already set up to support you with your data collection here. So thinking about how to ensure that you have the right controls and governance around your data collection as you're developing it will be really key. Okay, we'll keep that quick in the interests of time, but feel free to keep sharing on Menti, and others can, of course, look at your answers as they're coming in. But we'll be moving now into module 4, and thanks, Vanessa, for taking us through that.
Okay, thank you, Fiona. It's Vanessa here again for bringing you onto the final module of this training, which focuses on the when and where of disclosure of sustainability-related financial information. As with the last unit, we have 3 main sessions. To get us started, we will look at the location. First, in this session, we are looking to clarify where sustainability disclosures should be located. Before we dive into the specific requirements, let's think about sustainability disclosures in the context of a complete reporting package that is useful to investors. As you may all know, investors already have access to a company's financial statement, and the ISSB standards are designed to identify sustainability-related risks and opportunities that complement the financial statements. This all come together in a reporting package that we call general purpose financial reports. The requirements in the ISSB standards about what information to report are based on existing sustainability reporting regimes, which focused on investor information needs and on aspects of financial accounting standards. Furthermore, we were also familiar with like GRI standards, and GRI standards expand on sustainability metrics relevant to broader social concerns. And ISSB and GRI reporting standards share some context requirements, such as what to report. However, the ISSB standards are focused only on investors, so only on this stakeholder. So we only focus on investors' information needs and decision making, reflecting the mission of the IFRS Foundation, which is to bring transparency, accountability, and efficiency to capital markets around the world. Both organizations take different approaches to define materiality, but they are not competing. The GRI approach is set out and understood among sustainability practitioners, whereas the IFRS approach is similar to accountants and relies heavily on management judgments, and they align with existing corporate risk management process. So in together, these frameworks enable companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions, aligning both investor priorities and broader social expectations. A simple example is where a double materiality assessment identifies that some of the company's impacts may also create sustainability risks, which could be so significant that they are important to disclose to investors. And as we just noticed, materiality has different definitions for different reporting standards and audience. So let's briefly recall what we mean by material information for the IFRS. So in identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities, which could reasonably be expected to affect the company's prospects. So once the company has identified those risks and opportunity, it can then determine what information to provide about those risks and opportunities. And that is where our materiality definition comes to in play. And the definition of material information used in IFRS S1 is based on and aligned with definition found in the IFRS accounting standards. It is information that, if omitted, misstated, or skewed by other information, could reasonably be expected to influence investor decisions. So in other words, the ISSB standards just seek to identify disclosure of key information that matters to the investors. An entity determines what constitutes a sustainability-related risk or opportunity based on its facts and circumstances. Entities often have well-established process for identifying, assessing, and responding to sustainability-related risks and opportunity as part of the management of their business. Furthermore, we understand that investors have asked for disclosure of material information, and the ISSB standards have been designed to help you gather and disclose it. However, this means that a company does not need to disclose information that is not material, even if the ISSB standards include it as a specific requirements. There are a few things to remember. Firstly, ensure the material information is clearly identifiable, then that you use plain language. And secondly, ensure the material information is not scattered across your disclosure. And thirdly, include any additional or non-material disclosures if it is required by your regulators, but ensure it is clearly identified. So in November 2024, last year, IFRS has also released further educational material providing further guidance for companies on identifying and disclosing material information on the sustainability-related risk and opportunities. And also, I strongly encourage you to take a further look. So now let me stop here to have a Zoom poll to test your understanding on the material information. So this question tests your understanding of the definition of the material information, the materiality. And I think I have recorded in this training a few times. Okay, for the benefits of time, I will stop here. So yes, I'm surprisingly, it's actually not all the correct, not all the answers are correct. Only A and B are correct. So we need to be aware of unless it has been determined that the particular values being exemplified are expected to have a financial effect on the company. So this may not be the information that is necessary. So the correct answer is A and B, and we are not choosing C. Okay, moving on. Disclosure under the ISSB standards has to accompany the financial statements and be part of the same general purpose financial reporting package. However, as IFRS S1 does not say where in that reporting package the information should be provided. That is designed to allow jurisdiction-specific requirements on the location of reporting. The most important factor to consider here is to ensure that sustainability disclosures are provided as part of the same reporting package as the company's financial statements. Sustainable disclosures must be provided at the same time as the related financial statements, cover the same reporting period as the financial statements, and authorized by the same body or individual authorizing the financial statements. I would like to highlight a research by the WBCSD on the state of integrated reporting. It shows that nearly 2/3 of the companies continue to put sustainability information in the standard note reports. However, the ISSB standards require material sustainability-related financial disclosures should be included with the general purpose financial reports. So you will find like some of the examples highlight later. They will have additional footnotes in the financial statements. So this suggests that many companies to have some way to go to get their internal process and support and disclosure plans aligned within your corporates. So let me hand over to Louis for bringing up this example.
Thank you very much, Vanessa. And this is an example again from Ayala, the Philippines conglomerate. And it's an example that shows how they help readers navigate all of the information that they provide in their integrated report. So we've already heard about the global baseline, the building blocks, the need for connectivity, the need for sustainability information to be produced at the same time as the financial statements to which they relate. So in other words, a lot of information can go in a single report. How do you navigate it? Well, Ayala uses the integrated reporting system, if you like, of capital inputs and value generated as a way of navigating their report. So you can see on the left, they show what types of capital are necessary to input to their business in order for them to produce value. In terms of what this means for the structure of their report, they show the value creation process as being at the center of it. And you'll see that they tell you where to find the page number for the outlook, the material topics, and their stakeholder engagement and risks and opportunities. So they're showing us the page numbers that relate to each part of the value creation process and the disclosures that they make about them. So that's the first thing. The second thing to note is that they use icons here. So if you look at the vision pillar in the middle in the orange circle and the focused execution in the last section, you can see that they're using this little cog within a skull shape to show that this is something to do with our strategy and vision and how we execute our strategy. So the icons tell us a lot about how to navigate the information as well. But this is only one way in which you can do things. And of course, this presupposes that your information is available as a PDF document. But Vanessa's now going to tell us a bit more about the evolution to digital reporting.
Yes, thank you, Louis. As we all may know, like digital reporting is like a growing trend now for some of the formats of the disclosures. So technology is an emerging consideration for disclosures. And increasingly, corporate reporting is moving, Increasingly, corporate reporting is moving from PDF reports towards information on web pages with structured datasets, such as those datasets offered by the stock exchanges. And the IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and complying materials of the ISSB standards. So the taxonomy does not introduce any new requirements. A digital taxonomy provides the common elements or texts needed to make your sustainable disclosure machine readable. This makes it easier to take large data sets, such as information from an entire industry, and bring them all together to analyze them. I would like to mention a number of benefits regarding the digital reporting. Firstly, it makes the reported information easier to use for analysis. Data is structured the same across business in a machine-readable format. And secondly, tagging the information potentially allows for automated checks for quality and consistency. And thirdly, more and more data connection and management systems are compatible with digital reporting taxonomies, which could improve processing and report preparation. And lastly, the text can have labels and descriptions in multiple languages. If you report your quantitative data in one language, someone speaking another language can also understand what it means. So following the discussion on the location and timing, let's now take a further look about ensuring efficient disclosures. We have added this in our training because there are common comments we find from companies is that there is a growing reporting burden. So what we hope to highlight here is when done correctly, efficiencies can be made to reduce that burden. So first of all, I would like to highlight effective communication. First of all, it's important to understand what effective communication looks like and what it is required. Often, companies think that if they just put all the information together into one report and everyone will be satisfied. However, this would be against the core concept we mentioned earlier before, in particular for presentation. So for example, it could be helpful to ask these questions before your reporting. So the first one is the information clear and concise? So what we mean by clear here, it means it might depend on the nature of the information. For example, whether it could be clear to present information in tables, graphs, diagrams. And the second term here is concise. To be concise, disclosures needed to avoid boilerplate information, unnecessary duplication of information, and to use clear language. And the second method is the quality of information disclosed. So some preparers watching today might be thinking to themselves that they still don't see what all is about. Perhaps their experience focuses on standard non-sustainability reports, or they haven't had much interaction with the external audit. First of all, the accountants watching today, I would say to be kind to your colleagues, how to understand the differences that's required in the data connection, oversight, sign off for financial statements. So this means, for example, disclosures include comparative information and are to be restated as necessary. And disclosures avoid unnecessary duplication and cross-reference as required. And information has to be material to be connected and aggregated or disaggregated appropriately. So as you may have already noticed, there may appear to some overlap in the disclosure topics. For example, you might have the same governance approach for all sustainability issues rather than duplicate certain information. You can use cross-referencing to enhance the efficiency of your disclosures. So cross-referencing to other reports is permitted as long as the other report is available on the same terms and at the same time as the sustainability disclosures. So in simple words, they have the same reporting period. So the cross-referenced information is assumed to become part of the reporting package. And also cross-referencing shall be applied consistently and transparently. It shall not result in the information becoming more difficult to understand. And now let me hand over to Louis for bringing up another example.
Thank you, Vanessa. This is just a simple example about cross-referencing and shows how ArcelorMittal, which is a steel manufacturing company, how they did cross-referencing in their 2024 sustainability report. So it's quite straightforward, this one. You can see the title says IFRS Content Elements and Concept / SGG Index, and this is just an extract. they're showing in the left-hand column there all the content elements and concepts that map to the IFRS sustainability standards. So governance, we've already talked about, haven't we? Risks and opportunities, strategy and resource allocation. Then in our response part of the table, you can see where they have disclosed the information. So sometimes the information that they're cross-referring to is in the same report. So under governance, you'll see they say, see governance and risk management report in this 2024 sustainability report. In other cases, they're referring to the current report and something else. So on risk and opportunities, as well as referring readers to the sustainability, to the risk and management section of the sustainability report, they also refer readers to the Form 20F, which is a US registration form. And similarly, under strategy and resource allocation, you can see they cross-reference to 3 things, to the business model section of the sustainability report, to the annual report and the 20F. But in summary, they've used this table to show cross-referencing so that readers can find information about each of the content elements and more detail if necessary. Thanks, Vanessa. Back to you.
Thank you. So moving on, I would like to share there are a number of mechanisms to support preparers to get started with the ISSB standards. So firstly, one simple thing to put in place was to adopt well-known terminology and concepts familiar to preparers. So borrowing from the IASB, for example. And secondly, many requirements in the IFRS S1 and S2 are to be applied appropriately. Recognizing companies will have a range of capabilities and preparedness on these issues. For example, qualitative scenario analysis is permitted, and you will see the phrase all reasonable and supportable information at the reporting dates without undue cost or efforts, or commensurates with skills, capabilities, and resources in a number of places and our standards. And thirdly, reliefs for the first year of application have also been introduced in our standards. It includes companies being able to limit disclosures to climate in year 1 and begin reporting on their other sustainability-related risks and opportunities in year 2. And second, companies being able to provide annual sustainability-related financial disclosures with their last half-year reporting, rather than at the same time as the financial statements. And also, companies not needing to provide disclosures about Scope 3 GHG emissions apply the GHG protocol corporate standard to measure emissions if they are already using a different measurement approach, or provide comparative information in their first year of reporting using first S1 and S2. And another relief allows company to include GHG emissions information obtained from other companies in the value chain with a different reporting cycle. And we have already mentioned a number of other sources of guidance and resources, and also some links we left in the chat box, including SASB standards, CDSB frameworks, application guidance, among many others. So those reliefs are designed to enable companies to put in place reporting practices and structures to provide high quality, decision useful information. And jurisdictions will decide when to mandate adoption, but the standards are effective from 2024, January 1st, and we will know many companies are now preparing to adopt them voluntarily. So now let's take a break. Not take a break. Take a pause here for the Zoom poll to test your understanding for what we mean by the disclosed information here. So information disclosed in accordance with the ISSB standards should be A, decision useful, B, material, C, misleading, and D, comparable. Okay, for the time benefit, let me stop the Zoom poll. Yeah, it's good to see the correct answers is all but C, but still we can see one person choosing misleading. so that information disclosure should be decision useful, material, and comparable. Let's quickly move on to like another sample. Also testing like whether you find the information is decision useful if it is A, relevant or faithfully represented, and B, comparable, C, verifiable, D, timely, and E, understandable. Yes, and then we'd like to take a pause here. Yes, the correct answer is all of them. It's good to see like all of you can select the correct answers. Okay, moving on. Finally, the last section of our last unit, we focus on how you can ensure that the users of financial reports have confidence in the data you are disclosing, as trust is an essential component of sustainability-related disclosures, and there are increasingly concern over the greenwashing. So an important trust builder is showing the data and trends over time. So this is why ISSB standards ask for comparatives. So what we mean by comparative information here, comparative information provides context and helps to indicate process and underpin strategy and risk management. And also the measures disclosed by a company might be redefined or replaced over time. So or the company might change its method for estimating or calculating the metric. In these situations, it's important for the company to revise the comparatives to enable investors to compare and analyze current period data with the relevant period figures. And occasionally, a company's sustainability disclosures might contain material errors. In this situation, the company is required to restate these errors in the comparatives provided. And also, revisions or restatements are necessary only when there is a risk that material information being omitted, misstated, or obscured as a result of not revising or restating those comparatives. Lastly, information can be qualitative or quantitative. And we have faced that, like companies sometimes express concern with like sharing information they're afraid they deem to be sensitive, and or if the information could reduce their competitive advantage. And the ISSB standards relieve a company from disclosing information about a sustainability related opportunity if that information is commercially sensitive. So if that is a concern you may have, there is a further detail you can read in your handout. And finally, it's important to build confidence by providing clear statements of the compliance. We should know that a company that complies with all requirements in the ISSB standards, even the release is required to make an explicit statement of compliance. And we also publish further guidance on this in September 2024, what we called Voluntarily Applying ISSB Standards, a guide for preparers. And lastly, there are a few things or gentle reminder for you. Firstly, work through the list. And secondly, you can find in like the handout slide deck, like additional slide in this session with reminders of how to report effectively. And I strongly recommend to take a further look. And now let me hand over to Fiona for the wrap up of the module 4.
Great, thank you very much, Vanessa. And as you've probably just heard, we're very close to wrapping things up now. So big well done, and please stay with us for the final sections just to wrap things up. And we're also going to have a closing remark from our colleague Nikidi at the ISSB as well. So just to summarize what we've heard in our final module there, we discussed where to report information, and what was important here was the audience, or who you're reporting to. So being sure to be clear from the start who the primary user of information is will really help you to ensure that this information is ultimately right for their needs. And then we moved on to discussing efficiency in reporting. And I think the key takeaway here would be that less is more. So, of course, the objective here isn't to overload investors or other stakeholders with information, because actually that could be harmful and it could obscure the information that is material. And this is where using the standards as you get started can be a good guide to make sure you're focusing and providing what disclosure investors need, which of course is the overall purpose of the ISSB standards. And then finally, we discussed report user confidence. And especially in the current climate of greenwashing accusations or possible legal battles over public statements, it's important to ensure that data is not only accurate, but that it's presented in a way that builds confidence among report users. And so this is where the disclosure plan that we've been discussing throughout the course, and which you can continue to develop through the homework exercise, can help you to do this. Because if you develop a good disclosure plan, you'll have a clear and documented process for reporting the data that your investors need. Okay, so just do a quick time check. Yeah, I think we have time. We'll just do our final Menti exercise quickly in the interest of time, but just as a quick reflection wrap up. So I'll just move the Menti along, and I'll just ask Landon if you wouldn't mind just resharing the link one last time. Thank you. So our final exercise is just to reflect on some of those techniques and approaches that we've heard that might help your reporting be easier to navigate and help your stakeholders to find what you need, what they need in your reporting. So you can access the Menti again at the link that Landon has shared, and I'll just quickly share my screen and we can see what your ideas are with that. So any tips or thoughts on maybe things that you're already using that would be helpful to share with others regarding how you help make your reports easier to navigate, or anything maybe you have heard so far that you might want to start doing for future reporting? Great. So just using a good tech table of contrasts and having clickable, accessible links, indeed, using cross-referencing, maybe using charts and infographics, having good, clear headings. And I think one thing we heard about there with those headings as well is try to use consistent terminology that draws from the standards, that's easy for people to recognize the aspect of disclosure you're addressing. Maybe using standardized software. Great, lots of good ideas here. And keeping in mind those points around comparability and understandability, indeed. Ensuring the titles actually describe what is in the section is a good point, indeed. Making sure there's a good connection between the content and what you're using as the structure. Sectionizing your reports, using a consistent format. Yeah, maybe different topics, taking the same format into each of those topics is certainly helpful. Brilliant. Thank you, everyone, for sharing those. So just good to get a sense of some of your ideas there. And I think they align well with what we would recommend too. So that's great. So to close us out, I'm going to be covering a few wrap-up points in terms of resources and next steps. But really to round off our session and the content we've heard, I'm very pleased that we're joined by Ndidi, who is an ISSB board member. So Ndidi has been a member of the ISSB board since 2022. And she's really had a career that has focused a lot on that interconnection between business and sustainable development, working across multinational and indigenous organizations, as well as the public institutions and civil society in Africa and Europe. So some fantastic experience that she brings to the ISSB. So Ndidi, the floor is yours, and I believe you also want to share some content, which is fine. So I'll stop sharing my screen now so that you can share from your side.
Thanks, Fiona. Thanks, everyone. Great session. Also so excited because I see that this is just ahead of a session that we will have in Nigeria in September. So I'm really glad. And the reason why I want to share some slides is I've just come out of a session in South Africa. I don't know if you can see my slides, where South African companies are referencing Nigeria as a leader in terms of implementation of sustainability related requirements. in terms of disclosures that speak to investors. And that just made me very happy. If I had more time, I'd tell you more about that. But what I just wanted to remind you of here is why are we doing this, and why is it important to Nigeria? I know I have 5 minutes, I've got my eyes on the clock. And just a reminder that when the ISSB standards were issued, the TCFD was folded into the ISSB. And a reminder that the TCFD was set up by the FSB in it was set up in the 2015 era by companies that, and if this was not a quick one, I'd ask you to guess how much capital was behind the companies that set up the TCFD that became part of the IFRS Foundation, and that amount is 223 trillion US dollars. So in other words, what we're doing is we're not just talking about the theory of information that unlocks capital, but actually also talking about the practice of unlocking capital, because it's already speaking to standards. I'm seeing that you're just seeing slide 1. Are you still just seeing slide 1?
It's moving, but we have the we don't have the presenter view mode, so I don't know if you need to switch your screen.
I know. So Neil is tipping to me in the sidelines to say that it's not moving. So just checking now. Are you on slide 2? Or on
Yes,
slide
we are. Yes, yeah, we can see slide 2.
Are you on slide 3 now? ISSB milestones 2021 to 2023.
No, just number 2 on the TCFD recommendations.
Okay. So it's not moving then. It isn't moving. So we're just going to stay in this because at least I know it moves.
Yes, exactly.
Okay, brilliant. Let's just stay here. Because I just want to run through this just to make those points about not just that. And the reason why I talk about the IOSCO endorsement of IFRS S1 and S2 shortly after it was issued is because IOSCO represents 130 countries. And on the IOSCO board is the chair of the Nigerian SEC. He is also the vice chair of the Africa Middle East Regulatory Commission. So what happens is, and I'll come to this at the end of the slides, is it's not just that Nigeria raised its hand first, it's also playing a role. Now, the thing I wanted to talk about today was just the role that you can play in the room, not just in terms of learning the ISSB standards, but also in terms of shaping them, and that's where the SASB standards come in. So the next slide really just speaks to when are the enhancements to the SASB standards consultation being consolidated? And that is exactly now, because last year they were internationalized, and now there is a consultation that's ongoing. And if you remember, you would have been told during the course, IFRS S1 and S2 require cross-industry and industry-specific information. And there is guidance from the industry-specific guidance. But why does this matter? Why industry standards? 2 reasons. 1, because risks are location and industry-specific. But secondly, also because very often you can actually start from an industry lens in terms of identifying what your material metrics are, those metrics that speak to investors in terms of unlocking capital flows. And not just that, it also reduces the cost of reporting, so it's a proportionality tool. You may not already know that there are priority industries, and the ones that are listed here, oil and gas, for example, are 4 of the exposure drafts that have been exposed. Construction materials, you all know that I was formerly the Chief Sustainability and Governance Officer at Dangote. So of course I hear construction and I hear cement, and I know how important that is. Metals and mining, iron and steel, coal production, processed foods. And what's also going to come later on in the year is agriculture, electricity, energy, power, all these industries that are so critical to Nigeria. And the point is, you can actually make a difference in terms of shaping what these standards are, shaping what these metrics are. And I'll just speak for a moment about what I heard in South Africa today from the mining industry, from the largest miner, Sasol, essentially, and also Anglo-American Platinum and Anglo-American, essentially the global metrics in the world today do not necessarily reflect the metrics that are material to the South African space. Likewise, it is not clear that the SASB or the industry-specific metrics of the ISSB reflect the metrics that you use and that you know are material to your industries. And in shaping these standards, you don't have to fill the whole survey, but the link is here and I'll put it in the chat. You can just write, read, and learn about the standards, but in a way that actually helps you to shape them. And this is my final one. Just remember, Nigeria set the ball rolling. Nigeria sits on the ISSB, the only African country that does. It was the first to raise their hand to adopt the ISSB standards. The ISSB chair always says that. The IOSCO AMERC vice chair is the SEC DG. The UN ISAR chair is the FRCN CEO. So Nigeria isn't following. They are shaping and leading the agenda for emerging markets. So what has to happen next? What I hope is that the next time I'm in one of these calls, one of the case studies is a Nigerian case study. And the way to do that is really to understand what is it, for example, that you have already done that has attracted capital to you or won deals or gotten cheaper financing because of sustainability-related disclosures. And I know that they're there. Where do you have evidence that actually sustainability reporting has served as a competitive and a strategic advantage? How can industry-specific metrics, which vary from industry to industry, help you to cut through the chase and get the decision useful information that's relevant to investors and helps you achieve your objective? But my last point is you can shape these industry specific metrics that are so fundamental and core and are likely to be even adopted by jurisdictions. And I won't name any right now, so I'm not politically incorrect. But more importantly, these metrics that will become the global standard will only be fit for purpose and only be truly global if you also participate in shaping what these standards look like, if you participate in shaping how they actually capture the metrics that define what investors consider to be decision useful. That's it. I'm done.
Thank you so much, indeed. A fantastic way to close out the session and a real encouraging call to action there. So many thanks, and fully echo and support everything that you highlighted there. I'm sure it'll be well received by our attendees. I can see from all of the reactions we're getting. Well, fantastic. That brings us very close to the end of the session. So in the interest of time, I'm going to skip a few slides that you can review in the handout if you want to look at them offline. That's when it lets me move the slides, that is. Okay. So just in the background, there's a final Menti question for those who still have Menti open, just to let us know how your learning has progressed through this training. So please do let us know in Menti where you think you're at now. To mention also, as we said, we talked about our homework assignment, so please do find that on the webpage if you're interested to use that to develop your draft disclosure plan. We'll just flash past a few key resources. So the IFRS Knowledge Hub and their e-learning modules are great resources to help you to continue to support your journey here. So you can find more detail on the slides and of course the standards themselves. We'll highlight the IFC's Beyond the Balance Sheet program in the links there that Landon has shared as another option to support you. And finally, the SSE toolkit, which we've shared with you already. Okay, but this brings us to one important point we need to cover before we finish, which is a big thank you to all of you for staying with us throughout this full 3.5 hours of training. We know this is a long time to be together online, and we're really appreciative of your time and interaction. And as a token of that appreciation, you'll be able to receive a completion certificate for taking part in the course. So Landon has just posted the instructions in the chat there for you to access this. So firstly, you'll need to complete the feedback survey, which we shared the link to in the chat. You'll then get sent your certificate within up to a week from taking part in the survey. If you don't get it in the chat there, you'll also get an email as a participant within the next day from Zoom, and that will share that link with you again. So if you take part in that survey, you'll get your certificate from us in about a week's time. Please be sure to check your junk folder as well if you are missing your certificate, as sometimes they can go there. With that, I think that just brings us really to a few final thank yous. Firstly, to the SSE supporters, and then all the organisations who've made today possible. So the IFRS sustainability team, and in particular to Vanessa, Neil, and Ndidi for their support for today's session, the IFC, and of course, a big thank you to the team at NGX and the X Academy, including Ugochi and Tony, for their great support for this training. And a big final thank you to all of you for joining us at the training session. We really appreciate your time and energy, and wishing you all of the best as you take forward your disclosures. And as we say, we look forward to featuring Nigerian examples in our next iteration of the training. So big thanks all, and enjoy the rest of your day. Thank you.